Hello everyone. I hope we are live. I want all of you guys to give me a confirmation if the audio video is clear. Can you guys hear the audio, see the video? Just give me a confirmation, everyone. Accordingly, we'll start our session. Perfectly clear. Absolutely no issues. Audio, video, screen, everything is clear. Okay, great. Hello my dear warriors, I hope you guys are all doing amazing. So this is going to be a quick and comprehensive revision of the chapter Advanced Capital Budgeting. Before we begin with our session, just very simple things. Yes, I know today you've given your examination. Today was your FR examination. I hope your exams went exceedingly well. Now I'm not going to ask how your examinations have been. For some of you guys, the exams would have been great. For some of you, exams would have been very bad. For some of you, exams would be okay. Irrespective of whatever your FR exam was, the point is we have two more examination and we have to give in our 100% to our two more examination in the first group. The game is not over unless it is over. Even if your FR exam was great, still you have to give your two papers. Even if your FR exam was very bad, still you have two more papers. So just tell to yourself, from my end, from my perspective, whatever maximum I could have done, I have done. Now it is out of my control. The only thing in my control is how I prepare and give my AFM audit as well as the balance papers. Okay, point number 2 being, now advanced capital budgeting. Yes, the regular batch covering all questions would be somewhere around 25 hours. Yes, if I take a detailed revision explaining all the concepts and all master questions, it will come somewhere around 5 hours. Yes, along with that, we normally come up with a rocket revision wherein I'll just keep on telling the terms. It will get over in 25 minutes. Now, I was supposed to take a revision of this chapter some 10 days back, but I was not keeping well voice, all those issues were there. So from the past so many days, I was having that confusion. If I come up with a revision of 5 hours, one day before examination, it will not be worth it. If I just finish it off in 25 minutes, could be possible students would not understand anything. So what to be done? So yes, after thinking, we have now finally decided we will be having a 100-minute revision series of this entire chapter. Okay, all the points I will try explaining, but if you are someone who is listening to this chapter for the very first time, if you are someone who is watching this video subsequently on YouTube, yes, just to check how well the faculty teaches or how much conceptual understanding you will be getting, please do not refer this. Okay, here we are not here to tell each and every point, but one day before examination, the maximum time you can devote for this chapter is 2 hours. I will try giving you maximum coverage in the 2 hours. Is this clear? Yes, the main 3 topics from which, yes, most probably a question can come in this chapter is going to be, first is sensitivity analysis, second is going to be statistical techniques, third is going to be replacement decisions. We will be doing each of these things. So shall we start, everyone? Yes sir, let us start. Now understand, normally whenever I am taking a decision, short-term decision, we will be taking a decision based on marginal costing basis. Yes or no, everyone? Yes sir. Say for example, simple, I purchased a calculator today at 100 rupees. Tomorrow I want to sell. Minimum how much I want? 100 rupees at least I want. Yes or no? But understand, whenever I am taking a long-term decision, I will be using capital budgeting decisions. Just a very simple example. Imagine I decided we are going to manufacture and sell wine. So today, I purchased all the raw materials, I manufactured wine, I incurred 100 rupees cost. But wine, I have to store it. So I stored it for 1 year. Okay. Now after 1 year, yes, all my raw material I purchased at a loan at 10% interest. I want to know what is the minimum selling price I should be getting. Tell me students, tell me. Today I have paid 100 rupees. My cost is 100 rupees. I am selling it after 1 year. If I get 100 rupees, is it sufficient? Yes or no? Sir, it is not sufficient. Why? Because cash flows are for different period. Okay, so the simple rule throughout this entire chapter is, whenever cash flows are going to be for different period, we are going to bring them all together to present value and then compare. Is this clear, everyone? Throughout, that is what we are going to do in this entire chapter. Okay, sir. That means what is the minimum selling price? I will tell boss 100 rupee cost is there for 1 year, 10% interest is there. That means 110. So now very simple thing. Yes, from present, if I want to go to the future, look at this everyone. From present, I want to go to the future. I will add interest or I will include my interest. Yes or no everyone? 100 rupees is there. Yes, on that 10% interest I want. That means 110. Or I can tell 100 into 1 plus 10% is 0.10 is 1.1, it becomes 110. So from present, if I am going to future, I am going front, I will include interest. Okay, but from future, I am coming back to present value terms. I will eliminate the interest component, not going in too much detail. Yes, 100 I want 1 year later. That means today how much I want. I will eliminate the interest component. I will do divided by 1.1. I will be getting the present value. Yes or no? Using cross multiplication also I can do. Look at this. Present value, future value. Today if it is 1, at the end of 1 year it is going to be 1.1. That means today if it is 100, at the end of 1 year how much? Yes, into 1.1. Okay boss. Today is 1, after 1 year it is going to be 1.1. That means after 1 year if it is 100, today it is how much? 100 divided by 1.1. Is this clear everyone? Very simple point. From present to future I am going. I am going front. I will include interest. In this interest is not there. I will include interest. That means I will multiply 1 plus interest. Is this clear everyone? Okay. Yes, but from future I am coming back. I have to eliminate interest. Yes or no? That means I will do divided by 1 plus interest. Is this clear everyone? Okay boss. Simple point. Now one more example I am giving. Look at this. All these cash flows are there. Imagine for a project at t is equal to 0 I have invested 1000. Year 1, 2, 3, 4. I am getting 400, 400, 400, 400. I have to bring every cash flow to 0. How do I do it? Simple, sir. Year 1, 400 is there. I want to bring it to 0. Eliminate 1 year's interest divided by 1.1. Second year. Yes, from here, first I will bring to first year, then I will bring to 0th year. 2 times I will eliminate. Divided by 1.1, again divided by 1.1. That is divided by 1.1 square. Okay, third years 3 times I will eliminate, divided by 1.1 to the power of cube. Yes, fourth year I will eliminate 4 times, divided by 1.1 to the power of 4. Is this clear everyone? Simple terms. I am just spending some 5-10 minutes because throughout this entire chapter we'll keep playing with that. Okay, now imagine I am telling, okay boss, same example. I am telling now I don't want to value at 0, I want to value at t is equal to 4. Can I do it? Yes sir, simple. Look at this. This 400 is already at 4. I need not do anything. Keep it as it is. Boss, this 400 is at third year. I want to take it to fourth year. 1 year interest add into 1.1. Sir, 400 is at second year. One time I add third year. Second time I do fourth year. 2 times into 1.1 whole square. Okay. First year it is there. Second year, third year, fourth year. 3 times I will be doing into 1.1 to the power of cube. Yes, this from 0 to 1, 2, 3, 4. 4 times I will be doing. Is this clear everyone? One final thing. Imagine randomly I am telling I want everything at t is equal to 2. Why? Chumma, for my fun I want. I'll tell okay boss, simple jujube only this is. Look at this. This 400 is already at second year. No issues. Okay. Sir, this 400 is in third year. 1 year back I am coming. Divided by 1.1. This 400 is in fourth year. I have to bring it to the second year. Third year, second year. 2 times I will eliminate. Divided by 1.1 square. Okay. 400 is in first year. Take it to second year. Yes, 1 time I will add into 1.1. From 0th year, 1 time, 2 time into 1.1 whole square. Is this clear everyone? Okay. Now, one more simple thing. If interest rates are different, we will be using it subsequently. Okay, now look at this very simple example. Imagine at t is equal to 0, 1000 rupees I have invested. T is equal to 1, 400. First, let us understand with this simple example. Imagine 100 rupees I invested in a bank. First year, they are giving me 10%. Second year, they told they are going to give me 12%. Total, how much I will get? Simple, sir. On 100 rupees, 10%. 10 rupees I got. That means 110 I am having. On that, again, 12%. 13.2. That is 123.2. In simple, I can tell, okay, boss, 100 if I put. First year, I am going front. How much percentage? 10%. So, into 1.10. Second year, again, I am going front. How much I want? 12% into 1.12. If I do this also, I will be getting 123. Is this clear? From here, yes, 1.1 into 1.12. Is this clear, everyone? Okay, sir. Suppose question is telling that at the end of second year I am having 123.2, come to 0th year. I will tell, okay boss, from here to come back to first year, 12% interest I will eliminate, divided by 1.12. From here to come back to 0, 10% I will eliminate, divided by 1.1. Is this clear, everyone? Okay, sir. Yes, same things are there. Look at this simple example. I will just take one example, finish it off. Yes, I want present value at t is equal to 0. Yes, 1000 rupees I have invested, 400, 400, 400, 400 I am getting. But interest rates are 10%, 12%, 14% and 15%. Slowly, one step at a time. First year's amount 400, I want to bring it to 0. That means I will eliminate first year's interest. Yes, divided by 1.1. Sir, second year's 400, I have to bring it to 0. Slowly, one step at a time. From second year to first year, what is the interest? 12%. I will eliminate that, divided by 1.12. Now I reach first year. From first year to 0th year, again I will eliminate how much? 10%, divided by 1.10. So it is divided by 1.12 into 1.10. Is this clear? Third year's interest 400. So from third to second, 14%, divided by 1.44, sorry, 1.14, 1.12 and 1.10. Fourth year, it's going to be the same story. Is this clear, everyone? Is this point clear? Okay. So look at this basics, present value and future value. If from present I am going to future, I have to include interest. I will do into 1 plus interest. If interest rate is same, I will directly do into 1 plus interest to the power of n. If interest rates are different, yes, every year I will do it separately. Yes, into 1 plus interest 1, 1 plus interest 2, so on and so forth. From future, I want to come back. I have to eliminate interest. That means I will divide. Yes or no? Future value divided by 1 plus interest. Rate is same means directly to the power n I will do. If it is different means individually I will keep cancelling. Is this clear, everyone? Okay, boss. Now comes the most important concept here, that is the concept of NPV. I know you would have all heard of NPV. Yes, quickly in 5 to 10 minutes we will discuss it, because this entire chapter we are doing NPV calculation only, nothing more we are doing. Okay, sir. Simple. I am telling at t is equal to 0, I paid 100 rupees. At t is equal to 1, I am getting 110. Can I directly accept? No, sir. I have to bring it to present value. Yes or no? The simple thing is every cash flow I have to bring it to present value terms. Okay, sir. What all cash flow is there? Sir, at the start of the project, I will be incurring some initial investment. I have to purchase machinery and all. Okay. Then during the life of the project, I will be getting some cash inflow. Yes or no? Simple. Imagine I decided starting a sugarcane business. Starting, I purchased a machine. I paid cash. During the life, I am getting money by selling sugarcane juice. Okay. At the end of the life, okay, business is over. Now I am deciding I am having this sugarcane machine. What will I do? I sold it. From that also I got cash. Yes, at the end of the life, I will be getting some terminal value. What I have to do? Every cash flow, I have to bring it to present value term. End of the story. Is this clear? So every item one by one, let us quickly discuss. Pay attention, everyone. First is going to be my initial investment. Yes, at the start of the project, what all amount I will be paying? Firstly, to purchase the asset, purchase cost I will be paying. Yes, sir. Now, to install the asset, some incidental expenses I will be incurring. Okay, that also I am paying. Okay, I will add that. But sir, yes, if at all I get some subsidy, that I am getting it back, I will reduce it. Say to purchase asset I paid 1 lakh, installation I paid 10,000, so 1 lakh 10,000. Imagine government told, okay, it's a good product, I am giving you 5,000 subsidy. That means net from my pocket 1 lakh 5,000 is gone. Is this clear? Okay, sir. Next comes cash inflows during the life of the project. Throughout the life of the project, what all I will be getting? Pay attention, everyone. From this, I prepared sugarcane. I am deciding to selling sugarcane. Okay. Firstly, I got sale value. Imagine 1 lakh sale value I got. Okay, that cash I am getting. Okay, but to get this, I would have incurred some cost. So cost I will reduce. Imagine 60,000 is my cost. I reduce that. So I am getting my EBITDA, EBITDA. Okay. Yes, 40,000. Okay. From that, I'll have to pay depreciation also. So I will reduce the depreciation. I am left with earning before interest and tax, which is 30,000. Now, from this, I will directly reduce my tax. Now, understand, in this, I will not be reducing interest. Do not reduce interest. Yes, in the question, it will not be there, but still, yes, we will not be reducing interest. Why? Because when I'm bringing things to present value, that itself means I'm eliminating interest, right? So there is no need to do it again. Okay. But from this, I'm telling 30 rupees. Yes, earnings is there. Government is asking tax. Imagine 30%, 9 rupees tax we have paid. That means I'm having a profit after tax, which is called as no PAT, which is 21. Yes, but in reality, this depreciation of 10 rupees I have not paid, students. I have just reduced it to consider my tax expenses. So I will add it back. I will be getting my cash flow after tax of 31. Yes, you've done this so many times. Simple. I'm telling, okay, boss, 100 rupees sale value I got. Okay, 100 rupees I'm having. 60 rupees cost I paid. That means 40 is there with me. 40 cash is there. 10 rupees depreciation is there. Tell me whether 10 rupees depreciation I'm actually paying. No, sir. 40 rupees is there with me. But while I'm calculating tax, yes, I will get benefit on that. So for that purpose, I'm reducing. So cash is 40 only. But I told, okay, boss, tax I will not be paying on 40. I will reduce the depreciation of 10. I will be getting 30. On this 30, I will pay tax. 30% tax, imagine 9 rupees tax. So that means, tell me, 40 rupees cash was there, 9 rupees tax I paid. That means 31 rupees ultimately is cash I am having. Is this clear, everyone? Yes, simple format is there. Sales minus cost minus depreciation gives me earnings before interest and tax. From that, if I reduce my tax, gives me my profit after tax. On that, I will add depreciation, because depreciation is a non-cash item. I will be getting my cash flow. Simple note, interest I will not be reducing, because while I'm discounting, that itself means that I'm eliminating that interest factor. I'm not explaining in detail, student. Okay, sir. Yes, all these we do, sir. No issues. Yes, the main thing here is calculation of terminal value. Yes, at the end of the life, I don't want the sugarcane machine. I'm telling I will sell this. So when I sell the asset, I will be getting some cash. Yes or no? Sale value I will be getting. But when I get the sale value, yes, on that, if there is a gain, government will ask tax on that. So I'll have to adjust my capital gains. So that will give me my terminal value. So look at this simple thing, students. How do I show my capital gain adjustment? This is going to be important. So many places it is coming. Okay. Tax adjustment on capital gain. Yes, imagine. Yes, I sold an asset at 100 rupees. Its book value was 60 rupees. That means 40 rupees is my capital gain. Yes or no? On that, I have to pay tax. Okay. That means it is cash outflow. Okay, sir. Imagine, yes, book value of asset is 100 rupees. I sold it at just 60 rupees. That means 40 rupees is my loss. I'm crying. 40 rupees is my loss. Capital loss. Now, if I'm having capital loss, that I will adjust it against some other income. Okay, so I will be getting some benefit from that. Yes or no? As good as cash inflow. Now, don't tell me, sir, income tax rules, it cannot be set off, all those things. Here we are directly doing the adjustment. Okay, students? Okay. Now, look at this simple 3 situations I'm telling. Situation 1. Okay, asset is having a carrying value of 10,000 rupees. 10,000 rupees is what is shown in the books. I sold this asset at 15,000. Okay, boss. That means 5,000 capital gain I got. Now, what will bank? Yes, no, what will government tell? Government will tell 5,000 gain is there. Pay 30% tax, 1,500 tax. That means ultimately how much amount I got? 5,000 minus 1,500, 3,500. Yes or no? Absolutely wrong. This is where most of us will commit mistake. Very simple, repeating it again. Pay attention, students. I sold the asset. How much cash I got? Sir, I sold the asset at 15,000. That means 15,000 cash I got. Now, carrying amount, capital gain I calculated. All those things are just calculations. Yes, tax I paid. How much tax I paid? 1,500 I paid. 15,000 I got. In this, 1,500 I paid. That means 13,500 is there with me. Yes or no? So, from my sale value, I will just be adjusting my capital gain in order to arrive at my terminal value at the end of the life, how much cash I am getting. Is this clear? Second situation, 10,000 means no gain. That means no adjustment. Third situation, okay, asset is having 10,000 value, but I sold it at 6,000 only. That means 4,000 loss was there. So government will give me 30%. Yes, tax benefit on that. 4,000 into 30% is 1,200. That means ultimately 6,000 I got by selling asset. 1,200 tax benefit also I got. That means total how much rupees benefit I got? 7,200. Is this clear? Not explaining how we are getting this tax benefit in detail. Yes, if you want. Yes, in the regular batches and all, we would have explained. Is this clear, everyone? Okay, sir. Now, once we got all those things, look at this. I got my initial investment. I got during the life how much cash inflow I am getting. At the end of it, what is the terminal value I am getting? I will bring all my cash flow to the present value. I will discount it. Yes or no? I will calculate NPV, net what is the amount. If the net amount is a positive, means accept the project. If net amount is a negative, that means reject. Is this clear, everyone? Okay, I will calculate NPV, which is present value of cash inflows minus present value of cash outflow. Based on that, calculate decision. If NPV is positive means accept, negative means reject. Yes, now comes a very important thing. Sir, if NPV is 0, what should I do? Should I accept or should I reject? The answer is we will still accept the decision. Because understand, students, what is NPV telling? NPV is telling how much extra return I have earned. In very simple terms, I'll tell you. Imagine I invested 100 rupees today. I'm telling I want 10% return. Okay. Okay, boss. So if at the end of 1 year, if I get 107 rupees, am I happy? No, I am not happy. I will discount it to present value, telling at the end of 1 year, I got 107 divided by 1.10. I will be getting less. Imagine I got 110 rupees. Yes, did I get what I expected? Did I get how much I wanted? Did I get anything extra? Will I accept this? Yes, I will accept this. Now look at this. At the end of 1 year, you will discount it divided by 1.1. 110 divided by 1.1 will be 100. Cash inflow is 100. Cash outflow is 100. NPV here is 0. What does it mean? NPV means that, yes, whatever is my expected return, over and above that, how much extra I am getting. I am telling if NPV is 0, extra I did not get. But whatever was required, what was my expectation, that I am earning. I'll tell even if my NPV is 0, I will accept the decision. Is this clear, everyone? Now additional working capital adjustment is not required. Interest, I've told, we will not be reducing it because while we are calculating present value, it gets adjusted. Discount rate, if question tells you, we will use that. Otherwise, if cost of capital is given, we will be using that. Okay, sir. Simple allocated fixed cost as well as historical cost, it is already incurred in the past, so I will not be considering it in calculation of NPV. Now, one very important thing throughout your entire AFM, yes, if present value factor is given in the question, that itself I will use. If it is not given, yes, I know how to do it. If it is 10% means I will do 1 divided by 1 plus 1 divided by 1.1, but I will take it only up to 3 decimal. That is what ICA normally does. Okay. Example, all those things are there, which is not required. Let us just quickly summarize what I've told. Pay attention. NPV, 3 cash flows are there. Initial investment, cash inflow during the life of asset, and terminal value. Initial investment, how much I've paid? Purchase cost plus installation expenses minus subsidy. Okay, during life, what all I've got? Yes, sales minus cost minus depreciation gives me my earning before interest and tax. From that, I will reduce tax. I will arrive at my profit after tax. On that, I will add depreciation. I will arrive at my cash flow. Terminal value, at the end of it, how much I've got? It is a sale value. Yes, I'm getting that. Plus or minus capital gain. If it is capital gain means I will pay tax minus. Yes, if it is capital loss means I will be getting tax benefit. I will add it. Is this clear? In simple, NPV also I have explained. Now, next we are having profitability index, not at all required from examination perspective. I will not be discussing it. Next thing is internal rate of return. Again, all these things long back from inter days itself it is there, but still we will keep using this subsequently. That is why I'm still touching upon these points. Okay. Okay. What is internal rate of return? IRR means actually how much percent return we want. Very simple. Look at this very simple example. Imagine I decided I am going to manufacture beer. Okay. 100 rupees I have invested. Yes, I want 12% return. Okay. At the end of 1 year, this beer I sold and I earned 120 rupees. Tell me, I will discount it and I will calculate NPV. I will do 120 divided by 1.12. Yes, that is present value of cash inflow minus 100. I get my NPV as 7 rupees positive. What does it mean? It means that, okay boss, I wanted 12% return. Yes, I earned that 12% return and over and above that, 7 rupees extra profit I've earned. Yes or no? Okay. That means actually the return that I've earned, is it more than 12% or less than 12%? It is more than 12%. So I am asking actually how much return I have earned. That is my internal rate of return. Okay, internal rate of return means actually how much return I have earned. Point number 1, yes, IRR is that rate at which NPV becomes 0. Okay, now imagine I discounted at 18%. How do we calculate internal rate of return? Yes, we will be doing interpolation. Randomly I will put a rate. Yes, if that is a rate I will check. Imagine this same story. I will discount it at 18%. I will do 120 divided by 1.18 minus 100. I will be getting NPV of 1 rupee. That means I'm telling a bit more than 18% I'm earning. If I discount at 22%, my NPV becomes negative. Now using this, how do we do interpolation? Most of the students commit a mistake here. Pay attention. Very simple, very logical, nothing. Now look at the students. Yes, am I getting 18%? Yes, sir. I'm getting a bit more than 18%. Am I getting 22%? No, sir. I'm getting a bit less than 22%. That means how much I'm getting in between 18 and 20. Okay. I am telling from 18 to 22, if I increase my discounting rate by 4%, okay, what happens to my NPV? My NPV is, imagine this is 0, from 1.6949 it comes down to minus 1.6393. That is, my NPV reduces by 3.3342. Yes or no, everyone? Yes, sir. So I'm telling simple, boss. If I increase my rate by 4%, my NPV reduces by 3.334. Okay. Now I am going from 18%. I am telling, boss, am I earning 18%? Yes, sir. I am earning a bit more than 18%. How much more I want? Sir, at 18%, my NPV is 1.6949. I want it to become 0. That means I want my NPV to reduce by 1.6949. Yes or no? Simple logical explanation. Pay attention. I am repeating it again. If I increase my discount rate by 4%, my NPV will fall by 3.3342 rupees. Yes, I want my NPV to fall by only 1.6949. That means how much percentage I should increase the rate? Cross multiplication. So I will do, yes, 18% I am earning plus extra how much I want to earn. It is 4 into 1.6949 divided by 3.3342. You will be getting close to 20%. Is this clear? Simple way of calculating internal rate of return. Look at the steps to calculate internal rate of return. Step number 1, all cash flow I will calculate. Okay. Then after that, using trial and error, that is using interpolation technique, I will have to calculate my IRR. How do I do? Yes, first I will select a random imaginary rate. I will calculate NPV. Okay, if NPV is positive, that means more than that I am earning. I will increase the rate. If NPV is negative, that means that much I am not earning. I will reduce my rate. Finally, I will obtain the two rates that will make NPV close to 0. Preferably, one rate will make NPV positive, one rate will make NPV negative. That is what we have to arrive. Trial and error, continuously keep on playing with the rates. Okay. Yes, ultimately, once we get those two rates, yes, ensure that the difference between the two rates is not huge. Yes, preferably 5% will keep playing. 10%, okay, then 15, 20, 25, that way we will keep on playing. Yes, finally, I will do interpolation and based on that calculate my IRR. Okay, now one more example is there. Look at this. All cash flows I have given here. I'm not explaining in detail. If I discount at 15%, my NPV is 13,000. So I'm telling, okay, boss, more than 15% we are earning. I discounted at 18%. I'm getting some 3,000 rupees. So I'm telling a bit more than 18% I'm getting. I discounted at 20%. I'm getting minus 2,800. That means actually how much return I'm earning between 18 and 20 I'm earning. How much I want to know. Yes or no? So I'm telling, okay, boss, I am earning between 18 and 20. How much I want to know. I am telling, okay, boss, from 18 to 20%. That is, if I increase the rate by 2%, what happens to my NPV? NPV was 3,300 something. It came down. It went to 0 and it went to minus 2,800. That is, my NPV reduced by 6,191. Yes or no? Okay, sir. I am telling, yes, if my discount rate increases by 2%, my NPV falls by this much. By how much I want to reduce my NPV? Sir, at 18% it is 3,346. I want to bring it only till 0. That is, I want to reduce it only by 3,346. If I am to reduce this by 3,346, how much percentage should I increase? Cross multiplication is 3,346 into 2 divided by 6,191. 18% already I am earning. How much extra I want? Plus I will do and I will play 19.08%. Okay. Yes. What does it mean? What is its interpretation? It means actually 19.08% I am earning. Point number 1. Point number 2. If I discount all the cash flows that I have given at 19.08%, my NPV will become 0. Is this clear, everyone? Yes or no? Concept 0, that is the basics that we should be knowing. We have covered. We have finished it off. Is this clear, everyone? Can we proceed further to concept 1? Giving all of you guys 1 minute to just let the things settle in. I know we are going very fast, but we don't have an option. It is one day before examination. We cannot give more than 2 hours to this chapter. Okay, I can convince you for each and everything that I'm doing, but I don't want to, because we are only having 1 day left for exam. Okay, let the things settle in. We will continue. Yes, everyone. So let us continue our discussion. Concept number 1, it is risk analysis in capital budgeting. Very important concept. Now understand, I calculated NPV. If NPV is a positive, I will accept. NPV is negative, I will reject. But tell me, when am I calculating this? Before starting the project, I am standing here and thinking, should I start sugarcane business or not? I will estimate what all cash flow will be there, how much discount rate I want, how much at the end of it terminal value I get, how much initial investment I want, everything. Okay, yes, recording will be there, dear, don't worry. Okay, but all these are estimate that I have done. Can it be possible that they will go wrong? I thought that 40,000 I'll be getting every year, but in reality I got 30,000 only. Possible? Quite possible. So yes, risk is there. Yes, risk is there. So what should we do to mitigate that risk? Okay, so for the risk, different techniques are there. Conventional technique is there, statistical is there, other is there. One by one we will do it slowly. First is conventional techniques. In that, two things are there. First is risk adjusted discount rate. Second is certainty equivalent. First one we will go for risk adjusted discount rate. Simple example I'll give. Imagine I'm having 1 crore rupees. Where should I invest? I'll tell, sir, simple option is there, sir. Invest in FD. Yes, if I'm investing in bank FD, am I having any risk? No, sir. Yes, how much return they are giving? Imagine they are giving me 8% return. Okay. Or option number 2. Yes, go invest in equity market. Okay, yes, I'm assuming, yes, if I invest in equity market, whether risk is there? Yes, sir, risk is there. I'm assuming it as base risk or 1 unit of risk. So I'm telling, okay, if you put in equity market, how much return you can expect? Tell me one simple thing, students. If I put the money in equity market and I get 8%, yes, equity market is giving me 8%, will I invest there? Yes or no? I will not invest. I'll tell boss, 8% I am getting in FD. If I am taking a risk means I want more return. Yes or no? Okay, assume equity market is giving me 15%. That means tell me, for taking 1 unit of risk, how much premium it is giving? Yes, base was without risk 8%. For 1 unit of risk 15%. That means for every unit of risk, it is giving me 7% premium. Yes or no, everyone? Okay, boss. Now imagine tomorrow I decide that I want to start another business. Some other business I want to start, which is even more risky. I'm telling 2 units of risk is there in that. That means how much return I should be getting. I will tell boss, yes, if I'm putting the money, yes, without any risk, I'm getting 8. That means this 8% in any case I should be getting. How much unit of risk I'm taking? 2 unit of risk. For every 1 unit of risk, how much return I want? 7%. That means for 2 unit of risk, additional 14% I want. So 14 plus 8, 22% I should be getting. Yes or no? Imagine, yes, business is even more risky, 5 times riskier. I'll tell 8% in any case I want. For every unit of risk, 7%, like that, 5 times risky means 7 5s are 35 plus 8, 43%. Is this clear, everyone? Yes, very simple thing. If my project is more risky, that means I want more returns in order to justify taking the risk. That means when I'm discounting my cash flows, if it is more risky project means, yes, I will use a higher discount rate. Is this clear, everyone? That is my risk adjusted discount. More risk means more discount rate. As simple as that. Is this clear, everyone? So look at this. If project is having a higher risk, then we want high returns. So while I'm calculating NPV, I'm using a risk adjusted discount rate, higher discount rate. Is this clear? As per RADR, high risk if a project is having means higher discount rate, I will discount it. Project is having low risk, low discount rate is also sufficient. Okay, so how do I calculate my risk adjusted discount rate? This we've been, yes, using this everywhere. Yes, CAPM also it is telling. I'm telling total how much return I want. I want a risk free in any case I want, plus because I'm taking risk, for that risk premium I want. Yes, what is the premium I want? Yes, it is required return of minus RF. It is for 1 unit of risk, how much premium, into risk index, how much risk I am taking. Simple example, imagine risk free I am getting 6%. Yes, company anywhere if it is investing means it is earning 14%. That means for 1 unit of risk, it is asking 8% premium. The new project is a 3 times risky. That means how much total return I want. I will tell boss 6% in any case I want. Yes, for every unit of risk, 8% premium I want. That means for 3 times risk, 8 is a 24 plus 6, 30% I want. Is this clear, everyone? Okay, sir. This is clear, sir. That is my risk adjusted discount rate. It is telling simple boss. Yes, in future I will get cash flows. Yes, sir. I will get cash flows. It includes risk. Yes, sir. If it has more risk means I will discount using higher rate. If it has less risk means I will discount using lower rate. If it has no risk means I will discount using my risk free rate. Simple. Okay. Now comes second method, conventional techniques, certainty equivalent. What is certainty equivalent? It is telling very simple. Boss, previously you told that your cash flow is risky. For that you used a higher rate. Yes or no? Now I am telling, yes, your cash flow is risky. Do one thing, convert it into riskless cash flow. Yes, if I'm using riskless cash flow, which discount rate I want? I want risk-free discount rate. Yes or no, yes or no, yes or no. Simple, students, pay attention. I am telling at the end of it, yes, today 100 rupees I invested. At the end of 1 year, I will be getting 120 rupees. Yes, whether this 120 rupees includes risk, I am telling yes. That means when I am discounting, I will tell use a risk-adjusted discount rate. Okay, is this clear? This is what AIR tells. Option number 2 is, it is telling, I'm asking whether 120 includes risk. I'm telling yes. I'm asking in this 120 total amount, you are telling how much amount you feel certainly you will get. Definitely you will get. In any case you will get. I'm telling 80% of that definitely I'll get. Randomly I'm telling 120 into 0.8, 96. This is my certain cash flow. Yes, in this 96, whether risk is there? No. This 96, if I'm discounting, which rate I should use? Risk-free rate only, because in this risk I've already eliminated. Yes or no, everyone? Simple. So what my RADR was telling that boss, in the cash flow that you're using, yes, risk is there. So what we will do, in my discount rate, I will be using a risk-adjusted discount rate. Okay, what a certainty equivalent tell? It tells directly that boss, yes, whether your cash flow includes risk, yes, it includes risk. Do one thing, directly calculate riskless cash flows, that is certain cash flow. Once you've got certain cash flow, now while you're discounting, you can directly discount using your risk free. Is this clear, everyone? So look at this. How do I calculate certain cash flow? It is nothing but the cash flow into certainty equivalent factor. Simple. Yes, I'm telling next year I'm expecting 1 lakh cash flow. I'm asking how much percentage is certain. I'm telling 0.8. 80% is certain. That means what is my certain cash flow? 1 lakh into 80% or 1 lakh into 0.8, 80,000. Is this clear, everyone? Yes, not at all. Important from examination perspective. Question will give you cash flow, certainty equivalent factor. If you multiply, you will get certain cash flows. Once you get certain cash flow, discount using your risk-free rate. You will be getting the NPV. Based on that only we are doing this. Is this clear? Everywhere decision making is based on NPV only. How do I calculate NPV? RADR tells cash flow keep it same, but discount rate na use risk adjusted discount. Okay, certainty equivalent tell boss cash flow, yes, risk is there in the cash flow now. Convert this into riskless cash flow or certain cash flow. Discount using risk free rate. Is this clear, everyone? Okay, so look at this. Conventional techniques. Just quick summarization. Risk adjusted discount rate. Yes, I am telling RADR. Yes, cash flow risk is there. So what I will do in the discount rate, I will include risk. Okay, what a certainty equivalent tell? Because cash flow risk is there. Now directly convert that cash flow itself into certain cash flow, riskless cash flow. So that while you're discounting, you can discount using the normal rate. Both are same only. Is this clear? Not getting into too much detail. Thereafter comes the next point, which is statistical techniques. This is going to be important, students. First, we are having the basics. Yes, basics in portfolio management. We've been learning foundation, interfinal. We've been learning, not going too much in detail. Again, I'm telling, but quickly, in short, I'm telling. Look at this simple. One simple example is there. Imagine you're going tomorrow, yes, planning to give your AFM examination. I'm asking how much mark you can get. You're telling that, boss, if exam is easy, na, I will get 70 marks. If exam is average, I will get 60. If exam is very difficult, I will still get 50 marks. I'm asking what is the probability? 25%, 50%, 25%. So if I ask you what is the expected marks, I'll tell yes, 70 mark. There is a 25% chance of getting 70. So 70 into 25 is 50% chance of getting 60 into this, you will be getting your expected mark of 60. Yes or no, everyone? Simple. Yes, we know that x bar is equal to summation p into x. Yes, x individually, what is the return I'm getting, into whatever is a probability, that gives me my expected return. Yes or no? Yes. Then comes my risk. I'm asking whether risk is there. Yes, is there. What is the risk? Now I'm telling I'm expecting to get 60 marks, but if exam is easy, I will get 70 marks. That means how much more I will get? Let me see the gaps. Yes, I was expecting 60, but I got 70. That means 10 more I got. X minus x bar. Yes, I was expecting 60. I got 60 only. No fluctuation, no risk. Yes, I was expecting 60. I got 50 only. 10 mark less I got. Yes or no, everyone? Perfect. So I did my x minus x bar. Now what is SD, student? Standard deviation. In very simple term, SD means average risk. When I did my average returns, what I did, all my returns into probability I did. That means here also, all my risk I calculated, x minus x bar, I should do into probability. But the issue here is, understand, risk I calculate from my middle value, that is from my mean x bar. Because it is in the center, 50% figures will be in the left, 50% figures will be in the right. That means when I do the average, it will always become 0 only. If you take the average of this, it will always become 0. But I want to calculate my risk. For that, what I will do is, my fluctuations I will square. Is this clear? That is what I am doing in variance. Not going in detail. Again, I am telling. So what I will do x minus x bar whole square. Then I will multiply by probability. Okay. Yes, 10 into 10. Yes, becomes 100 into 0.25, 25. Accordingly, I calculate. I will call this as my variance. Is this clear, everyone? So in very simple terms, the formulas, look at this. X bar, that is the expected return. It is summation p into x. Individually, how much return? Into probability gives me my expectation. Now I want to calculate my variance. It is denoted as sigma square. How do I get it? It is summation x minus x bar whole square into p. Yes, I want to know the risk, which is x minus x bar. But if I do x minus x bar, yes, what will happen is, yes, average, it will become 0 only. Yes, so I want to eliminate that. So I am squaring it, x minus x bar whole square. Yes, now I want to know how much is expected, so I will multiply by p. Is this clear? This is my variance. Variance is summation x minus x bar whole square into p. Yes, standard deviation is square root of variance, is square root of, yes, summation x minus x bar whole square. Is this clear? This is a very simple this thing. Look at this. Where is it? Okay, simple. If NPV of the project is available for you, yes, expected NPV, can I calculate x bar? Yes, individual NPV is available, probability is available, multiply, end of the story. Yes, can I calculate risk? Yes, boss, simple. Yes, variance, it is nothing but sigma square. It is summation x minus x bar whole square into p. Standard deviation is square root of variance. Okay, more detail of this is going to come back. Yes, we will do it after some time, because for that we want some other things as well. Now this I will keep it here. Next comes one of the most important and probable areas from your examination perspective, sensitivity analysis. There is every chance a question on this can come. Okay, I've told you 3 areas very important. First is sensitivity analysis. Second is going to be statistical techniques. Yes, third is going to be replacement. Sensitivity analysis, we will be spending a good amount of time here. Pay attention. Simple. Imagine there are 3 people. One businessman is there. He is earning monthly 1,50,000. His monthly expense is 1 lakh. That means how much he is saving? 50,000 he is saving. Okay. One more person is there who is going on a job. 1 lakh he is earning. 80,000 is his expense. 20,000 he is saving. Okay. One more article is there. Okay. Every month how much he is earning? 8,000 is earning. But 7,000 expense is there. So 1,000 is the expected saving. Now tell me one thing, students. Yes, this is the estimation that they have done. Whether risk is there? Yes, sir, risk is there. What is a risk? Sir, in any month, if income goes down, that is a risk. Okay. Or, sir, in any month, cost went up, that is also risk. Okay. Now, I am telling you what is a risk. Is if income comes down, that is risk. If expense goes up, that is also risk. Now, here I am considering one factor at a time, one risk at a time. Look at this, everyone. Yes, the simple background. Look at this. Yes, capital budgeting decision I took based on NPV. Yes, for NPV, so many factors are needed. All those factors at the start of the project, I am estimating, okay, this many years I can use, this much cash flow I will get, this much discount rate is needed, this is the initial investment, this is the terminal value. All these are just estimated. That means, is there a risk? Yes, there is a risk of adverse movement. So in sensitivity analysis, what we are going to do is, yes, we will see if one factor changes. If one factor changes, what is going to be the impact that we are having? Okay. So look at this, look at this, look at this. Yes, in simple terms, same story. Let us understand with the help of story. Then we will come back. It is going to be much more better for us. Pay attention, everyone. Same businessman is there. One person is going for a job. One more article. Yes. I am evaluating risk one factor at a time. Two factors are there here. Either income can change risk or cost can change risk. Firstly, I am only considering cost. Imagine that my cost increased by 10%. I am telling what will happen to my saving. How much effect I will be having. How much hit I will be getting. Yes. First businessman was there. 1,50,000 is the income. Only one factor I will be changing. Okay. In a real life, multiple factors can change. But in sensitivity analysis, at a time, only one factor I am telling. So I am telling, okay boss, my expenses can change. That means my income will be same only. Yes. Here I am telling my cost has moved in adverse direction. 10% it has increased. What will happen? Pay attention. Yes. Businessman had thought that 1 lakh will be his cost. It increased by 10%. 1.1 lakh it became. That means now how much will be his savings? 40,000 only. That means, can I calculate by how much percentage savings reduced? Yes sir, previously saving was 50,000. Now it has become 40,000. So from 50,000 to 40,000, 10,000 it has reduced. From where? From 50,000. That means 20% it has reduced. Yes or no, everyone? Perfect. Same is the case with the person going to job. 1 lakh income, I am assuming it is same. Expenses, I thought it was 80,000. In reality, 10% extra it became 88,000. That means savings now is only 12,000. Yes or no, everyone? Perfect. Now I am calculating by how much percentage my savings changed. I am telling boss, initially I thought 20,000 will be saving, but now it is 12,000 only. That means my saving has reduced by 8,000 from 20,000. 40% it has reduced. Similarly with article, yes, initially he thought 1,000 savings will be there, but now yes, savings is 300 only. That means his savings has reduced by 70%. Okay. So what I did, initial saving I calculated. After one factor changed adversely, revised the savings I calculated, percentage change I calculated. Now I want to know who is most sensitive. Understand students, if cost increases by 10%, na, yes, 3%, 3 people were there. Businessman was there. Next, job person was there. Article was there. Businessman is telling, even if my cost increases by 10%, na, my saving will come down by 20% only. Job person is telling, yes, if my cost increases by 10%, na, my saving will come down by 40%. Yes, article is telling, if my cost increases by 10%, na, yes, my saving will fall by 70%. Tell me, who is having the maximum risk here? Who is having the maximum risk here? Article is having the maximum risk here. Yes or no? Because if his cost increases by 10%, he will have the maximum hit. Yes, he is the most sensitive to change in cost. Yes or no, everyone? Perfect. So who is most impacted? Article. So it is the most sensitive. Is this clear, everyone? Yes or no? So now we'll look at this. Look at this. What is happening? Yes, let me summarize. Capital budgeting decision. I estimated factors. Yes, in that whether adverse movement is possible. So I want to know if that one factor changes in an adverse direction, how much impact, how much negative impact I'm having. Okay. Now what all factors are there? What do I mean by negative? Tell me, initial investment is there. What is the risk, students? Initial investment can be more or can be less. What is risk for me? If my initial investment comes down, it is good only. What is risk? If my initial investment increases. I thought for a project 100 rupees needed. It's actually 110 I paid. Oh my God, I'm feeling bad. Yes or no? Selling price reduced. That is risk for me. Variable cost has increased. That is risk for me. Fixed cost has increased. That is risk for me. Cash flow, how much cash I am getting from the project, it has reduced. That is risk for me. Project life, that has reduced. That is risk for me. I thought 5 years I will get money from that. Only 3 years I got. That is risk for me. Sales volume has reduced. That is risk for me. Discount rate has increased. That is risk for me. Not going in detail, students. There are two methods to calculate sensitivity analysis. First is wherein I am considering a fixed percentage change in every factor. Second is margin of safety approach. Question will tell you which approach to follow. Okay. First, a fixed percentage change in every factor. Yes, what we have to do? Simple. Existing NPV I will calculate. When that factor changes, what is a revised NPV and what is a percentage change in NPV I will calculate. Based on that, I will give a decision. Look at this one simple example we have put. Based on that, we will understand. One project we are starting. 1 lakh rupees cash I want to set up the project. 5 years is a life. 40,000 every year I am getting. 10% is my discount rate. Okay. First, I will calculate my NPV. I got boss 51,631 NPV. I am telling great. Now question is telling calculate sensitivity if each factor has adversely changed by 20%. So one by one we will have to analyze. Look at this everyone. Every factor we will analyze individually. Pay attention, most important. First, I am considering cost of the project. Yes, originally what was my estimate regarding cost of project? 1 lakh. But this is an estimate. There is a risk involved. Yes, what is the risk? What if my cost of project increases? Question is telling, yes, change it by how much percent? 20%. So if it increases from 1 lakh to 1,20,000, what will happen to my NPV? Yes, I will calculate the NPV. I am telling 40,000 every year I am getting into present value annuity factor minus initial investment now is 1,20,000. So how much NPV I will be having? 31,631. So look at this students. Previously my NPV was 51,631, but now it came down to 31,631. It reduced by 20,000 from 51,631. That means my NPV has reduced by 38.74%. Is this clear? Similarly, for every factor, one factor at a time, I will calculate the revised NPV. Now regarding cash flow after tax, yes, initial estimate was 40,000. Question is telling 20% adverse change. Imagine it reduced by 20%. It became 32,000. What is the NPV? NPV will become 21,305. That means by how much percentage NPV has fallen? 58% my NPV has fallen. Third, discount rate. Existing, we had estimated 10%. Yes, imagine adversely 20% adverse movement is there. So 10% plus 20% of that, it became 12%. Now what is my NPV? NPV will become 44,000. So from 51,000 it has reduced to 44,000. Yes, how much percentage it has reduced? 14% it has. Project life 5 year was there. If it has reduced by 20%, it will become 4 years. If 4 years only we are using, what will be my NPV? NPV will be 26,000. It means how much percentage it has reduced? 48%. So now understand interpretation. We will revise, summarize, don't worry. I am telling, if every factor adversely changes by 20%, what is the impact? If my cost of project changes by 20%, now what happens to NPV? My NPV will reduce by 28%. If my cash flow reduces by 20%, my NPV will reduce by 58%, boss. If discount rate changes by 20%, okay, only 14% NPV will fall. If project life reduces by 20%, my NPV will change by 48%. Tell me, where is the maximum risk? Where is the maximum risk? Sir, maximum risk in cash flow after tax. Yes or no? Why? Because if my cash flow after tax changes, yes, maximum hit will be there on my NPV. Yes or no, everyone? So what is the most sensitive factor? Is cash flow after tax. Is this clear, everyone? Yes or no? So now look at the steps. Everyone. What I am going to do. Step number 1, existing NPV I will calculate. Right now, how much NPV I am calculating. Step 2, for every factor that your question is asking, is first calculate what is going to be the revised value of the factor. Okay. Based on that, calculate your revised NPV. Get this? Yes, calculate revised NPV. That is, after your factor adversely changes, what is going to be the NPV? Calculate revised NPV. Once you have calculated a revised NPV, previously it was 50,000, now it is 40,000. Calculate by how much percentage your NPV has changed. Percentage change formula, simple. It is a change divided by original value. Yes or no? It is change in NPV divided by original NPV into 100. Yes, once you have calculated, now comes comment. Yes or no? Here comment is going to be very important. Yes, the factor with the highest percentage fall in NPV is the most sensitive factor. In our example, yes, when every factor changed by 20%, yes, NPV maximum change was when cash flow changed. When cash flow changed by 20%, my NPV fell by 60% something. So cash flow was the most sensitive factor. Is this clear? That is how I will be giving my judgment decision. Now there is one more way to do the calculation. What is this, sir? One more way. It is called as margin of safety approach. Now, this is going to be a bit tricky. Okay. In the limited time, I will try explaining. Please pay attention. Okay. Now, same example, 3 people were there, businessman, job, article. Yes, first let me take the example of businessman. Monthly 1,50,000 he is earning. What is his expected cost? 1 lakh. That means how much saving he is having? 50,000 saving he is having. Yes, I am asking, is there a risk? He is telling yes. What is the risk? Cost can go up. So I am telling how much cost can go. You don't have a problem. If 1 lakh is the cost, if your cost, imagine it became 1,10,000. Are you still fine? He is telling still fine. 1,50,000 income is there. 1,30,000 is your cost. Are you still fine? He is telling I'm still fine. 1,50,000 is your cost. Are you still fine? He is telling I'm still fine. Imagine your cost became 1,60,000. Are you now fine? No. Because my income is 1,50,000. Yes, my expense went up to 1,60,000. It became a negative. Yes or no? That means maximum how much your expense can be. Telling maximum 1.5 lakh if my expense is there. I'm still fine. I will not cry. Yes or no? Job person is telling 1 lakh is my income. That means maximum how much expense I can afford? 1 lakh. Article is telling 8,000 every month I'm getting. That means maximum how much I can afford. Okay. Yes. So I'm telling, look at this. Yes. Right now my expense, businessman is telling, right now my expense is 1 lakh. How much it can go so that I do not cry? Maximum how much it can go? It can go up to 1,50,000. That means how much percentage my cost can go up? Still I'm okay with that. From 1 lakh, it became 1,50,000. Means even if my cost increased by 50%, I am okay. My saving has become zero, but it did not become negative. For a person going in job, right now his expense is 80,000. Even if it became 1 lakh, he is okay. His saving will become zero, it will not become negative. It is even if his expense increased by 25%, it is okay. For article, right now his expense is 7,000. His expense becomes 8,000. His complete saving is zero. That means if his expense increased by just 14%, his complete savings is wiped away. Now understand the interpretation here. It is going to be important. Businessman is telling, even if my expense increased by 50%, I am okay, no issues. Yes, job person is telling, even if my expense increased by 25%, I am okay. Article is telling, if my expense just increased by 14%, all my savings will go. That means who here is most sensitive to change in the cost? Who has to be most cautious? Article has to be most cautious while he's spending money. Yes or no? Because if his cost just increased by 15%, his entire amount will become negative. Yes or no, everyone? Perfect. This is one more way of calculating in sensitivity. Here what I am telling, this is called as margin of safety approach. Just give me a minute, students. Yes, it is called margin of safety. Here what we are doing is, I am telling, okay boss, there is risk in the factor, I am telling, yes, how much value the factor can go so that NPV will become zero. Okay, yes, with the help of example, we will see one by one. Same example I will use. Look at this. Same 1 lakh project is there, 5 years life is there, 40,000 cash flow I am getting, 10% is the discount rate. NPV I calculated, I got some 51,000 rupees NPV. Okay. 51,000 NPV. Now, second, yes, I want to calculate sensitivity for cost of the project. I am telling how much my cost of the project can go so that NPV becomes zero. There is no negative NPV. Maximum how much it can go. Now my estimate is it is 1 lakh. Maximum till where it can go. Pay attention slowly, one step at a time. I don't know the cost of the project. Yes, whatever I don't know, we will be assuming it as X. So I am assuming cost of project is X. Yes, NPV is nothing but present value of cash inflow minus present value of cash outflow. I want to calculate the NPV. Yes, I want to calculate that point where my NPV is 0. So I'll put NPV is 0. Yes, 40,000 every year I'll be getting for 10%, 5 years. Yes, but cost of project I don't know. I will put it as X. Once you simplify, you get your cost of project as 1,51,361. What does it mean? It means that even if my cost of project becomes 1,51,361, I am okay. If it goes beyond that, I am not okay with this. Yes, my estimation was that cost of project is 1 lakh. Okay, boss. It went in adverse direction. Even if it became 1,51,361, that is, even if it increased by some 51 percentage, I am okay with that. Is this clear? Cash flow after tax, how much my cash flow after tax can be so that my NPV becomes 0. Approach too simple. I want to make my NPV 0. All other factor value is same. This one factor is changing. What should be this factor value? I will assume it as X. Simple. Okay. Cash flow after tax I want to calculate. I will assume that as X. I will put NPV is equal to present value of cash inflow minus cash outflow. NPV is 0. I will simplify. I will get 26,378 as my cash flow after tax. Okay. Discount rate I have to calculate. This is important, students. Understand. I want to calculate that discount rate at which my NPV becomes 0. Yes, at which rate I should discount so that my NPV becomes 0. What is question asking? What is it that I want? I want my IRR. So here I have to calculate my IRR. Okay. Look at this question told me that, okay, boss, 10% is what we are discounting. But at 10% I got my NPV as 50,000. That means more than that I am earning. Yes, I want to know maximum till where my return can go. So I will discount it at 15%, okay, 25%, okay, 30%. Based on that, I calculated my IRR as 28%. That means what is the meaning? Interpretation here is, okay, yes, actually I am earning 28.73%. That is one interpretation. Interpretation number 2. For this project, okay, the requirement is 10%. Okay, minimum requirement is 10%. Even if projects require, yes, investors right now are asking 10%. Okay. Even if investors ask 28.73% also, I am okay. Till then I'm okay. But if it goes beyond that, I am not okay with this project. Is this clear, everyone? Okay. So I'll be calculating my, yes, IRR in case of discount rate. Next comes life of the project. Pay attention. This is also important. 1 lakh rupees I've invested. Okay, boss. Yes. Project life I estimated is 5 years, but I'm asking whether risk is there. I'm telling yes, boss, risk is there. Yes, if project life comes down, there is a risk. I'm telling at least how much years project should go so that I can recover this 1 lakh, so that my NPV becomes 0. I want my NPV to be 0. That means cash outflow is 1 lakh, cash inflow should also be 1 lakh only. Okay, how do I do it? Now look at this. Imagine first year I run my project. How much cash I'm getting? 40,000. But 40,000 I'm getting on first year. Bring it to present value terms. It becomes 36,000. Second year I run my project. How much I will get? 40,000. That is second year. Bring it to present value. Yes, it is 33,000. That means, tell me students, if I run my business for first 2 years, first year as well as second year. First year's present value is 36,000 something. Second year is 33. That means first 2 years if I run my business, ultimately how much cash I will get on present value terms? 69,000. Yes or no, everyone? Perfect. So I will tell this is my cumulative present value. So what I want, simple, in case of project life, calculate present value of cash flows. Calculate cumulative present value. Once you have calculated cumulative present value, use interpolation so that you reach at that point where your NPV becomes 0. Okay, simple. I'm telling, yes, if only 1 year I run my business, I will get present value 36,000. If 2 years I will run, first year's plus second year's, total 69,000 I will be getting. 3 years I will run, first, second, third, I will be getting total 99,000. How much amount I have paid? 1 lakh I have paid. 3 years I run my business, 99,000 I will be recovering. Still a bit more I'll have to run. 4 years I run my business, I will be getting 1,26,000. That means between 3 year and 4 year, if I run my business, yes, I will recover. That is, I will reach my NPV. Yes or no? Yes, sir. How do I do the calculation? Simple. The calculation is using your IR, yes, interpolation technique only. Okay, where is that calculation shown? Here. Yes, if 3 years I run means 99,474. If it is 4 years means 1,26,000 something. That means if I increase 1 year, my present value is increasing by 27,320. I want it to go from 99,474 to 1 lakh. Yes, I want it to increase by only 526. That means how much more I should work? Cross multiplication. Yes, it is 526 divided by 27,320. So it becomes 3 years plus this one. It becomes 3.019 years. Is this clear, everyone? Yes or no? Yes or no? Yes or no? Now, yes, I will summarize this, students. Pay attention. Let me summarize this. I know it has been a bit fast, but we are helpless. Okay. So sensitivity. Okay. Pay attention. Summary. Sensitivity. How much? Yes, my factor can change. Two different approaches are there. Approach number one, wherein your factory is changing by a fixed percentage. This is the simplest way. Question will tell you by how much percentage every factor, yes, factor will change. Question told you 10 percentage adverse movement. Okay. Step one, I will calculate existing NPV of the project. Okay, I calculated. I got my existing NPV is 100 rupees. Now for every factor, just calculate the revised value of the factor. That is okay. Yes, 10 percentage adverse movement was there. That means what will become my factor? That means what will be my revised NPV. Okay, boss. Existing NPV was there. For every factor, revised NPV I calculated. Now I will calculate by how much percentage my NPV has reduced. Imagine my existing NPV was 100. Yes, after adverse change, my NPV became 80 rupees. That means my NPV has reduced by 20%. By how much percentage NPV has changed? Yes, change percentage is nothing but a change divided by original. Now decision making, yes, factor with the highest percentage change in NPV. Here highest percentage change is going to be my, yes, most sensitive factor. It is if my every factor changes by 10% adversely, my cash flow is changing by 80%. That is the most sensitive. Is this clear, everyone? Okay, sir. Second is margin of safety approach. That is, I want to make my NPV come close to zero. For that, by how much my factor can change. Okay. So again, step one is I will calculate existing NPV. Now second, I don't want to calculate NPV. I want to make my NPV become zero. For that, my factor, how much it can change. Look at this. Cost of project was 1 lakh. How much my cost of project can become so that NPV becomes zero. I want to calculate the revised value of factor so that my NPV becomes zero. And I know the original value of factor. I will calculate the revised value of factor. Based on that, I will calculate the percentage change in the factor. Is this clear, everyone? Based on that, I will be taking a decision. Here, when I am taking decision, factor whose lowest percentage change will make NPV zero. I am telling, okay, boss, right now all these things are there. I am telling, if my initial investment increases by 50%, NPV becomes zero. My cash flow decreases by 10%, NPV becomes zero. Yes, if cash flow just decreases by 10%, NPV becomes zero. Where the lowest change will make NPV zero, that is the most sensitive factor. Is this clear? Okay. Now, first method, there is no tension at all. Question itself is telling, yes, a fixed percentage change in every factor. Second percentage, I have to calculate the revised value of factor. How do I do? Simple logic is whatever factor I have to calculate, take it as X. But some exceptions are there. What are the exceptions? Firstly, project life. 1 lakh initial investment I have put. That means 1 lakh present value of cash inflows I want. For that, how much years I should run the project? Calculate present value of cash inflows. Based on that, calculate cumulative present value. Yes, year 1, year 2, cumulative value. We've just done that. Okay. And the point at which cumulative present value of cash inflow will be equal to present value of cash outflow. Okay, that is going to be my project life. How will I get it? Using interpolation technique. Simple, this format I will be following. First year, how much cash flow I got? Yes, present value factor, I will get the present value, cumulative value. Second year, cash flow, present value. First and second year, cumulative value, I will keep on doing. Now, yes, wherever, yes, it is reaching close to my amount invested. Interpolation technique I will follow, I will calculate the value. Okay, boss. Discount rate is how much discount rate should be so that my NPV becomes zero. I will be calculating my IRR using my interpolation technique. Okay, boss. Next comes sales volume. This one more example was there. I have not taken this, but quickly I will tell. Look at this, students. Right now, I was selling 200, 300 and 400 units. Next year, how much unit I should be selling? Yes, or if there is a adverse movement, how much unit I should be selling so that my NPV becomes zero. Now understand, units I am selling in this ratio. So I will take my weights as 2x, 3x and 4x. Based on that, I will calculate. Is this clear, everyone? Next, any other factor? Yes, just simple. Take the missing figure as x and accordingly then solve it. But all other factor, fixed cost, cash flow after tax, initial investment, take the missing figure as x. But when it comes to selling price or variable cost, I will just show it. Yes, I will assume contribution per unit as x and accordingly I will be solving it. Look at this. Simple example 2 is there. Now, if you are having an idea on this, it would have helped. Otherwise, it would have been difficult. Simple example. Look at this. Every item I am selling at 100 rupees. Variable cost was 40. 5 lakh fixed cost. 3 years, these are the units sold, 10% discount I want, initially 20 lakh of good. Question is telling, okay boss, calculate sensitivity of selling price use as well as variable cost using margin of safety approach. Okay, I will calculate right now how much, yes, NPV I am having right now, some NPV I am getting. Now I want to know what should be my selling price so that NPV becomes 0. Simple logic is assume selling price as X, but I will not do that. I will assume my contribution per unit as X. Why sir? Because if I assume this, my calculation becomes simple. Look at this. First year, how many units I sold? 20,000 units. Every unit contribution is X. That means it becomes 20,000 X. From that 5 lakh fixed cost I paid. So it becomes 20,000 X minus 5 lakh. Yes, that is first year. I will bring it to present value into 0.909. I will get the present value of cash inflow. Similarly, year 2 and year 3 I will do. When I am calculating NPV, I am telling NPV is present value of cash inflow minus present value of cash outflow. NPV should be equal to 0. Present value of cash inflow. All these things I will consider. This is the value I got. Minus present value of cash outflow. At the start of the project, 20 lakh I am paying. I simplify this. Value of X, I will get it as 49.51. Now tell me what is X? What is X? What did I assume as X? Contribution. That means what should be my selling price? Simple. I am telling in every unit, if I earn 49.51 contribution, my NPV becomes 0. That means what should be my selling price? I will tell, okay boss, selling price minus variable cost is contribution. Contribution is 49.51. I want to know what should be selling price. Yes, that means this can change. What is my variable cost? 40. So take it to the other side. Selling price becomes 89.5. That means right now selling price is 100. Yes, even if it becomes 89.51, project is still okay. NPV becomes 0. Is this clear, everyone? Yes, that means how much percentage selling price will change, that you can calculate. Yes, using the same data for variable cost also I can calculate. There is no need to do the calculation again. That is, my contribution should be 49.51. I will tell selling price minus variable cost is contribution. Here I want to calculate variable cost. That is what I want to calculate. Contribution is 49.51. Selling price is 100. Means I will get my variable cost as 50.4. Is this clear, everyone? Accordingly, you can calculate the percentage change. Okay. This is my sensitivity analysis. Is this clear, everyone? Got a bit of idea? Okay. Now this concept in itself will require some two hours minimum for me to give you complete justification on each and every point. Okay, but in the given time, these summary charts are there. Yes, if you just look at these, it will help you, yes, to tackle questions quickly. Each and every adjustment I've tried covering, students. Okay, next point. Yes, after a 1 minute break, we will continue further, students. Yes, everyone. So let us continue. Now there are two more points. Next, scenario analysis is there. Yes, in scenario analysis, what is happening is, in sensitivity analysis, I have considered change in only one factor. In scenario analysis, I am telling, okay, yes, not just one factor, multiple factors can change, right, at a time. So we will, based on that, consider multiple scenarios, telling, okay, cash flow is also changing, initial investment is also changing, terminal value is also changing, discount rate is also changing. When all these factors change, in that scenario, what is going to be my NP? Okay, yes, not very important from the examination perspective. Yes, then again, decision tree analysis is there. Yes, decision tree analysis, again from examination perspective, I would tell not very important, so I'm not getting into that. Okay, one question is there, that question we will put here also as an example, but to tell you the logic for that, it will take me some half an hour. Yes, not worth it. Okay, from the examination perspective. Okay, now we will go to the next point, which is advanced statistical techniques. Statistical technique basics we have told, that is, in the question, if NPV is given, yes, what we have to do? Simple, calculate expected NPV, that is X bar, which is summation P into X. Based on that, calculate risk, that is variance, sigma square, it is summation X minus X bar whole square into P, or standard deviation, which is square root of variance. This one we have discussed, but Imagine NPV is not given. Question does not give NPV. Only cash flows are given. Based on that, how do we do? Yes, important students. Now understand, if cash flows and with probability is given, my cash flows can be three different types. Perfectly independent cash flows, perfectly dependent cash flows, or moderately dependent cash. Simple example I'll give you. Imagine. Yes, A, B, C, three friends, they decide to go on a trip. So C is telling that if A comes to the trip, only then I will come to the trip. Yes, in that case, what is it? Is it dependent or independent? This is dependent. Only if A comes, I am going. Yes or no? Yes. Or C is telling whether anyone comes or doesn't come, I will go to the trip. What is this? It is independent. Yes or no, everyone? Simple. Yes, you decide to get married. You are telling, okay, only if I am going to marry this person, X, I will marry. Dependent. It is dependent on that factor. I am telling any girl I'll get, any boy I'll get, I'll marry. Yes, what is that? Independent. Is this clear, everyone? Very simple. Look at this. Now, look at this first situation, students. Pay attention. 10 rupees I invested at t is equal to 0. First year, I can get 6 rupees or 8 rupees. Now, I am telling, second year, what all I can get? I can get 5 rupees or 7 rupees. Yes or no? I am telling, irrespective of what happened in my first year, whether my first year was good, it was bad, performance was good or bad, second year what I am getting? Second year, there is a 60% chance I will get 5 rupees. There is a 40% chance I will get 7 rupees. What is this? This is perfectly independent cash flow. Yes or no? Irrespective of what happened in year 1, doesn't matter. Second year, boss, there is a 60% chance I will get 5 rupees and 40% chance I will get 7 rupees. Is this clear, everyone? Yes, year 2 cash flow is not dependent. I will call it as perfectly independent cash flow. Okay, sir. Now, perfectly dependent. Look at this. 10 rupees I invested. First year I got 6 rupees. Okay. If first year I get 6 rupees now, or 8 rupees also I get. I am telling, boss, first year I got 6 rupees. First year my performance is bad. That means I am telling, if first year I get 6 rupees, first year performance is bad, then pakka second year performance is also bad. Second year I get 5 rupees. Is this clear, everyone? That is, for every one cash flow of year 1, there is only one cash flow for year 2. That is perfectly dependent. Independent, irrespective of what happened previously, I will get 6 or 8. Okay, here, yes, if 6 rupees I got last year, then definitely, compulsorily, 5 rupees only I will be getting this year. Perfectly dependent cash flows. Is this clear, everyone? Year 2 cash flow is fully dependent on my year 1 cash flow. Is perfectly dependent. Or third one is moderately dependent. It is dependent, but not fully. Look at this. If year 1 is bad, that is year 1 6 rupees only you got. Year 2 is also bad only. But year 2, what all can happen? It can be 5 rupees or 7 rupees. Is this clear? If year 1 is good, that is 8 rupees I got. Year 2 is also good. But how much good? Can be 8 rupees or 9 rupees. Is this clear? Yes. Is it dependent? It is dependent. If year 1 is bad, year 2 also somewhere is bad. Year 1 is good, year 2 is also good. It is not completely independent. But is it fully dependent? Perfectly dependent? No, it is not perfectly dependent. If it is bad, again, multiple outcomes can be there. Yes or no? This is going to be my moderately dependent cash flow. Okay, so my cash flow can be 3 different types. Fully, perfectly independent cash flow. Yes, irrespective of what happened in the last year. Yes, multiple cash flows will be there for the current year. Okay, perfectly dependent, completely dependent on previous year cash flows. Directly, only one outcome can be there. Moderately dependent. It is dependent on last year cash flow, but not perfectly. Multiple outcomes will be there. Is this clear, everyone? Somewhere you've got a bit of idea. Now, how do we calculate? Yes, expected NPV as well as risk. This is going to be very important, students. Pay attention. So look at this, everyone. Okay, let me take some 5-10 minutes to explain this because it is going to be very important. Most likely that it can come in the examination. Okay, perfectly independent cash flows. Okay, year 1 I invested 10 rupees. 70% chance of getting 6 rupees or 30% chance of getting 8 rupees. Now, irrespective of whatever happened in year 1, year 2 I will be getting 5 rupees or 7 rupees. Perfectly independent. Okay, now these are the cash flows. I want to calculate how much NPV I will get, point number 1, and what is the risk in the project. Now, simple approach, first approach is logical, path-based approach. I will tell what all can happen. Pay attention. It could be possible that I will get a cash flow of 6 rupees and 5 rupees. Yes or no? Or I can get 6 rupees and 7 rupees. Okay, or I can get 8 rupees and 5 rupees. Okay, or I can get 8 rupees and 7 rupees. What is the probability? What is the probability? I have to calculate joint probability. Look at this. Yes, there is a 70% chance of getting 6 rupees and 60% chance of getting 5 rupees. That means 0.7 into 0.6 is 42% chance of getting 6 as well as 5. Similarly, I will calculate yes or no, everyone. Okay. Now, 4 different options can be there. For each option, can I calculate NPV? Yes, sir, I can calculate NPV. For each option, path 1, I'm getting 6 as well as 5. 6 first year, bring it to present value. 5 second year, bring it to present value. I will get total present value of cash inflow minus present value of cash outflow. I will get my NPV. So various NPVs I got. Yes or no? Now once I get different NPVs, now story is very simple. Now NPV is there. What all can happen? Probability is there. If I multiply, I will get expected NPV. Yes or no? Yes. I want to calculate risk. What is risk? It is x minus x bar whole square into p gives me variance. Square root gives me standard deviation. I'm telling, okay, boss. Expectation is 0.78 NPV I will get. But it could be possible minus 0.42 also I'm getting. Yes. What is the risk? X minus x bar. Then I will square it into p. Yes. I will get my variance. Yes or no? Okay. If I take a square root of variance, I will be getting the risk. So look at this. This is the value I'll be getting. Expected NPV x bar is 0.788. Next, variance is 1.3515 as well as standard deviation is 1.162. This is the logical approach, detailed approach of doing the calculation. Here I could do it because only 2 years was there and everywhere only 2 option was there. Imagine question tells me 4 years are there. First year 4 possibilities. Next year for every item 4 more possibilities. Third year for every item 4 more possibilities. Fourth year for every item 4 more possibilities. That means total 4 into 4 into 4 into 4. 256 different possibilities there. Can I do that? For every possibility, I will calculate joint probability. For every possibility, I will calculate NPV. Based on that, I will do the calculation. Yes, I will calculate risk. Is it possible? Not possible. So for that, there is a shortcut. This is what we have to discuss. Yes, approach number 1 was a logical approach. Yes, for exam, I will not be doing it using this approach. Yes, the next set of things I will be using it using this approach. But for perfectly independent cash flow, I will not do it this way. Then what I have to do? Simple. Shortcut. This is what is Hillier's model. Hillier has given a shortcut. He is telling, boss, first, don't look at NPV. Only look at every year's cash flow. Okay. He is telling for every year cash flow is there. Is it there? We are telling, okay, it is there. For every year, can I calculate expected cash flow and risk for every year's cash flow? Look at this, students. Year 1, what all can happen? Year 1, cash flow can be 6 rupees or 8 rupees. Probability I know. So can I calculate expected cash flow? Yes, sir. From that, can I calculate risk, variance as well as ST? Year 2, again, what all cash flow can be there? It can be 5 rupees or 7 rupees. Same thing is there. Yes. Do I know the probability? Yes. Will I know expected cash flow? Yes. Can I calculate risk? So he is telling, yes, forget NPV, forget project. Every year's cash flow you see. I told, okay. Calculate expected cash flow x bar, which is nothing but summation p into x, and calculate risk. Formulas is going to be same only. Yes, variance is summation x minus x bar whole square into p. Standard deviation is square root of variance. I told, okay, boss, this much I did. What next? His calculation will have to be done for every year's cash flow. Then he is telling, based on that, for project as a whole, do the calculation. We are telling, okay, what is a calculation for project? Now, for the project, calculate the expected NPV. He is telling that, boss, for every year, you calculated your expected cash flow. Look at this. Yes, year 1, year 2. Yes, expected cash flow you calculated. Cash flow 1, cash flow 2. Based on this, can you bring these expected cash flow to present value and calculate the expected NPV? Yes, we can do it. So I told, okay, boss, we can do it. Yes, NPV is nothing but present value of cash inflow minus present value of cash outflow. Then this is the most important thing. Yes, here is where, yes, most students will not understand what is happening. We'll have to calculate the risk. For that, Hillier has given a formula. Yes, a small logic, a small, yes, way I will try explaining it. Pay attention to what I have done. I am repeating it again. This is the most crucial. Next 2 things are very simple. Perfectly independent is the most important. Okay. Most students will commit a mistake here itself. Okay. So first what I do, every year's cash flow, I will separately take. Year 1 cash flow I took, what all possibilities are there, probability, expected cash flow, risk I can. Year 2 I did, year 3 I did, year 4 I did. Every year I did. Now, every year's cash flow, expected cash flow I will take, based on that I will calculate expected NP. Now I'll have to calculate the complete risk in the project. I'm telling what is a risk, boss. Boss, risk is nothing but that my cash flow can change. Now understand, risk in my project NPV is nothing but that risk of the fluctuations in my cash flow. Cash flows can fluctuate. Now, do we know the risk of cash flow? Yes, sir. We have calculated every year risk of cash flow. Based on that, can I calculate the risk of NPV? Yes, sir. Simple. Add all those things. You will get risk of NPV. But wait. Now, cash flow is happening every year. Year 1 cash flow, year 2 cash flow, year 3 cash flow, year 4 cash flow. NPV is at T0. That means what I'll have to do? I will have to bring it to present value. Yes or no, everyone? Okay. Simple. Look at this. Cash flow of first year, I know the risk. That is, I know sigma, standard deviation of first year cash flow, standard deviation of second year cash flow, third year, so on and so forth. I want the risk of project, that is a risk of NPV. NPV is at T is equal to 0. So what I will do? I will bring it to present value. Yes or no? Yes. That means what will it be? I will tell yes. Sigma cash flow 1 into present value factor 1 plus sigma cash flow 2 into present value factor 2 for 2 years. Sigma cash flow 3 into present value factor 3. So on and so forth. Yes or no? So I'll first write yes, standard deviation of cash flow 1 into present value factor 1 plus standard deviation of cash flow 2 into present value factor 2. So on till n years I will do. Now understand one thing, students. Okay, throughout your calculation of standard deviation, everywhere, I will not be calculating standard deviation directly. We will first be calculating variance and then we will be coming back to standard deviation. Everywhere this is what we are doing. Yes, average risk I wanted. Did I get it directly? No. First I calculated variance. Then I took a square root and I calculated standard deviation. So here also I will be first calculating variance for the project. I want variance which is in square terms, but here I had sigma. That means what I'll have to do? I will have to square it. So what I will do? Every factor I will square it. Okay, that means what is the formula in detail? I am not explaining in very simple terms. I am telling, boss, first year standard deviation, I will bring it to present value. It is sigma cash flow 1 into present value factor 1. I want it as a variance, so whole square plus sigma cash flow 2 into present value factor 2. I want variance, so whole square. Sigma cash flow 3 into present value factor 3. I want variance, whole yes square. So on and so forth. Is this clear, everyone? Till n years. This is going to be my formula of variance. Once I get that, using that, I will calculate my standard. Okay, look at this simple example is there. Yes, I will do the application also. Look at this same project example. Okay, first I will take year 1 cash flow. 6 as well as 8. Probability is given. I am telling 6 as well as 8 can be there. Probability is there. Expected cash flow, I got it as 6.6. Variance, I got it as 0.84. Standard deviation, I got it as 0.9165. That is for year 1 cash flow. Then I will see year 2 cash flow. What all it can be there? It can be 5 or 7. Same thing, only in every situation it is repeating. Independent it is 5 and 7. What is the probability? 60 and 40%. So for year 2, 5 and 7 probability is given. Expected cash flow I calculated. Yes. Variance as well as SD also I calculated. Okay, boss. Perfect. Enjoying the lecture, sir. Thank you so much. Oh, thank you so much, dear. Okay, this is my most, what do you say, vulnerable time, because I do not take a class without giving 100% conceptual assurity. Okay, this is happening so that just because it is one day before examination, I'm not in a position to explain you guys everything as well. So I'm having that continuous, what do you say, that regret that, okay, I am not in a position to tell you the beauty of this concept, that how simple it is, because I'm bound by the time. Okay, so I'm having that regret continuously, but cannot help because it is one day before examination. I'll have to finish it off. Okay, we're already running behind time. So I'll tell, okay, boss, for year 1 cash flow I calculated, for year 2 cash flow I calculated. Now for project as a whole, first I will calculate X bar, that is the expected NPV. Okay, boss, for first year my expectation was that I will get 6.6 cash flow. For year 2 expectation is 5.8 cash flow I'll be getting. Yes, I will bring them to present value terms. I will get my NPV. Okay, boss, I got my NPV 0.7902. Now second thing is I'll have to calculate risk. Simple. This is where we'll have to do. Yes, first year cash flows risk, that is standard deviation I calculated 0.9165. second year cash flows also standard deviation I calculated. Now I want risk of NPV. Pay attention, simple. First I will be calculating variance. I will tell first year's cash flow, yes, the risk in that, yes, sigma cash flow 1. I have to bring it to present value into present value factor 1. Now this will give me SD. First I will always be calculating variance. It is in square terms into square. Plus second year I am having sigma cash flow 2. Standard deviation of second year cash flow. I have to bring it to t is equal to 0 into present value factor 2. Now I am calculating variance whole square. So on and so forth. Here it is only there for 2 years. I will use this formula. I will get my variance. Once I get my variance, take a square root. You will be getting your standard deviation. Is this clear, everyone? Yes or no? Give me a confirmation. Okay. This was the most complicated thing, students. If this is clear, na, everything else is clear. Now look at this, simple. I'm only telling, look at this, perfectly independent cash flow. What I have to do? Every year's cash flow you see. Okay, sir, I saw. In that, what we should do? Calculate, step 1, calculate expected cash flow, which is summation P into it. Then based on that, calculate risk in the cash flow. Okay, that is variance, summation x minus x bar whole square into P and standard deviation. Now for every year cash flow you have done. Now come to project as a whole. Okay, for project as a whole, calculate expected NPV of the project. How do I calculate expected NPV of the project? Again, x bar is summation P into x. Now every year's cash flow, I got estimate expected cash flow. Based on that we calculate. Now I'll have to calculate risk in the project. Yes, every year cash flows risk I got, bring it to present value terms, but I'm calculating variance, do it square. Simple. Bring it cash flow, I'm having standard deviation of cash flow, bring it to present value, I'm calculating variance, do it square. Sigma cash flow I'm having every year's cash flow, bring it to present value, I want variance, do square of it. Simple. Is this clear, everyone? This is the step to be followed. Yes, obviously it will require a bit of practice from your end as well. But this is the only thing that you'll have to do. The next two things are very logical. Okay, pay attention. In case of perfectly dependent cash flows, look at this simple example that is there. Imagine 10 rupees I invested. What all can happen? Either it can happen that I will get 6 rupees or 8 rupees or 9 rupees. Probability is given. Imagine my first year was bad. 6 rupees I only got. That means second year definitely I will get 7 rupees only. Third year I will definitely get 8 rupees. If my first year was okay, most likely scenario, 8 rupees. Second year I will get 8 rupees. Third year I will get 9 rupees. Yes, imagine if first year was great, best, 9 rupees I got. Second year I will get 10 rupees. Third year I will get 10 rupees. Now tell me, students, altogether how much paths are there? Only 3 paths is there. Path number 1, path number 2, path number 3. Yes or no? Perfectly independent, so many paths will happen. Here only very limited paths will be there. Yes or no? So for every path, can I calculate NPV? Yes, sir. Sir, in worst case, what can happen? In worst case, first year I got 6, bring it to present value. Second year I got 7, bring it to present value. Third year I got 8, bring it to present value. Calculate NPV. Okay. So this is also called as scenario analysis. That is, we will be having 3 scenarios. Best scenario, worst scenario, most likely scenario. Yes, in the worst scenario, calculate NPV. Yes. My cash flow, I brought it to present value minus, yes, initial investment. Most likely scenario, best scenario. I got my NPV. Okay. Now once you got your NPV, yes, you can directly calculate risk. Very simple. Directly you can do. Yes. Once your NPV, various NPV is there, na, we know the formula. Simple to do. Yes or no? Yes. NPV is there, different NPV. Its probability is there. You multiply, you will get expected NPV. Then calculate fluctuation, x minus x bar, individually x minus x bar whole square into P. You will get the variance. Yes or no? Once you get the variance, take a square root, you will be getting the standard deviation. Is this clear, everyone? Okay. Yes, we will go to the final situation. Yes, alternatively, there is also something called as Hertz model, but that is not needed because directly only quickly we will get in case of perfectly dependent cash flows. Third one is moderately dependent cash flows. Now understand, for moderately dependent cash flow, there is no shortcut, no option. We have to go for the path based approach. That is, individually we will see how many paths can be there. Yes, individually its joint probability I will calculate. Based on that, for every option I will do NPV and do my further calculation. Look at this. 10 rupees I have invested. First year can be 6 or 8. Second year can be 5, 7. If it is 6, it can be 5 or 7. If it is 8, it can be 8 or 9. So what all options can be there? Altogether 4 different options can be there. Yes or no? First option is, first year I get 6 rupees and 5 rupees. It's joint probability, 0.7 into 0.6, 0.42. Second option is 6 or 7 I can get. It's a respective probability. Third option, fourth option. Individually, every path I will see, that path's cash flow I will see, that path's joint probability I will see. Based on that, for every path NPV I will calculate. Okay, once I have calculated NPV for every path, once you know the NPV, na, things are simple, students. Once you have calculated NPV formula, yes, in my basic statistical techniques itself I have told, yes, x bar is nothing but, formulas are simple, students. X bar is nothing but summation px. Yes, variance is nothing but summation x minus x bar whole square into p. Standard deviation is nothing but square root of variance. These formula I will use once NPV is available. And in perfectly dependent and in moderately dependent, I will first calculate this NPV. Based on that, I will put these steps. Okay. But in case of perfectly independent, instead of calculating all those NPVs, there was a shortcut. That was my Hilliard's model. Okay. Now for every option, I will calculate expected NPV. Based on that, yes, variance I will calculate. Based on that, standard deviation I will do. Pay attention. Yes, revision. I will summarize. Again, I am telling this topic requires more time. Extremely sorry from my end. I am not in a position to do justice to these topics. But in the given time, there is no option. Okay, so pay attention, students. Simple. First, I have to understand what is a cash flow. Is it perfectly dependent, perfectly independent, or moderately dependent? Okay, sir. Now understand what is perfectly dependent. Doesn't matter whatever happens in the last year. Yes, these are the cash flows that can happen. Perfectly independent. Perfectly dependent. If first year is bad, means second year will be this only. 3 different scenarios will be given. Worst scenario, best scenario, most likely scenario. Yes, moderately dependent. Moderately dependent. Yes, for every cash flow, further 2 or more options will be given, but it is not going to be perfectly independent. Okay. Now understand one very important note, students. If a question does not specify which cash flow it is. Yes, imagine question told best scenario, worst scenario, most likely scenario. You got it is perfectly dependent. If question does not specify, default assumption is always we will be taking it as perfectly independent. Okay, now using that, how do we do the calculation? Simple. The entire statistical techniques I am summarizing it for you guys. Yes, even if you have not understood it, if you revise it, you will be in a position to get the answers. Okay, yes, logically, yes, I'm having so much regret that I'm not in a position to make justice to it. Okay, yes, forex rocket revision I'll be uploading it on YouTube, dear. Do well. Okay, now understand what all can happen. Yes, step 1, if NPV is given, question is directly giving me NPV, no tension only, I can directly do the calculation. NPV is available, I will calculate expected NPV x bar, that is summation p into x. Using that, risk I will calculate. Variance is nothing but summation x minus x bar whole square into p. Standard deviation is square root of variance. Okay, if I can calculate variance, simple, no tension. Now comes NPV is not given, only cash flows are given. What all can happen? Perfectly independent cash flows, perfectly dependent cash flows, moderately dependent cash flows. Perfectly dependent cash flows. First year 3 cash flows can be there. But if first year is bad, second year is also bad, third year is also bad. After that, only one situations, scenarios are there. Yes, step 1, I will calculate NPV for each scenario. Scenario 1 NPV, scenario 2 NPV, scenario 3 NPV. Once I calculate 3 NPV, then the step is going to be same. Okay. Yes, moderately dependent cash flow. Yes, I will be going for path based. Yes, every path I will see what all path can be there. Yes, every path, what is going to be the cash flow, what is the joint probability. Based on that, for every path NPV I will calculate. Once I get NPV for every path, then the steps are going to be same only. Okay, that means understand, students, understand. If NPV is directly given, great. If NPV is not given, but it is perfectly dependent cash flows or moderately dependent, yes, step 1 is always calculate NPV. Yes, different NPVs calculate. Once you have calculated NPV, now it is going to be simple. Expected NPV is nothing but summation p into x. Risk, that is variance, is summation x minus x bar whole square into p. Yes, standard deviation is square root of variance. Okay, now comes this side. In case of independent, perfectly independent cash flow, this is very important from examination also. Very likely that this can come in your exam. Hilliard's model is there. How do we apply Hilliard's model? Simple. It is telling first don't go to NPV. Do not calculate all those NPV. So much time it will take. First only look at cash flow. Every year cash flow, can you see? Yes, cash flow is there. Can you calculate expected cash flow, X bar? Yes, summation P into X. Can you calculate risk of the cash flow? Yes, variance as well as standard deviation can be calculated. Yes, same formula only. But here I am doing for cash flow. So year 1 cash flow I did calculation, year 2 cash flow I did, year 3, year 4. How many years cash flow is there? For every year cash flow, X bar as well as sigma I calculate. Okay, now I am telling come to project as a whole. We are telling calculate NPV of project. How to calculate? Every year's expected cash flow I have calculated. Bring that to present value. Expected NPV will get. Perfect. Okay. Then comes risk in the project. We are telling boss, risk in the project is nothing but risk in the cash flows. And I know my risk in the cash flow. We have calculated sigma cash flow 1, sigma cash flow 2, sigma cash flow 3. All these things we have calculated. Simple. Bring it to present value because I want risk in NPV. Bring it to present value into present value factor, and I will always be first calculating variance, which is in square terms. So into whole square. So first year cash flow into first year, yes, present value whole square, plus second year cash flow into second value PV factor whole square, plus so on and so forth. This is going to be variance. Is this clear, everyone? Yes or no? Yes or no? Yes or no? Perfect. Yes, couple of more pointers are there. We have finished. Okay, next important point is replacement decision. Maximum in 15 minutes we should be in a position to finish it off. Okay, 1 minute, just a relaxation for you guys also, for me also. Okay everyone, so let us continue further to the next concept, which is replacement decision. What is replacement decision? I am having an existing machine, but a new better technology machine is there. The question is, should I sell this machine and replace it by a new machine or not? Okay, 3 different situations are there. Again, going to be important from exam perspective. This is very simple concept, students. Okay, even if you just follow the steps, you will be getting the answer. Okay, so look at this everyone. Yes, imagine I have decided sugarcane business I am going to start. I am having existing sugarcane business. But I'm thinking, yes, I will sell this existing machine and new machine I will purchase. Why, sir, new machine? What all benefit will be there? Sir, I will get more sale because better quality. My cost will reduce. Less employee would be sufficient. Waste will be less. More juice will be, I will be getting. Okay. So how much extra benefit I will be getting? I told if I go for new machine, now 1,20,000 extra benefit. But for that I have to purchase new machine. For that, how much extra cost I have to pay? Imagine 1 lakh extra cost I have to pay. That means net, if I purchase the new machine, what is the net extra benefit? 20,000 is a net extra benefit. Should I purchase? Yes, I should purchase. No, wait. Understand, extra 1 lakh cost I am paying here, but benefit I am getting slowly over the life. That means period is different. What I'll have to do? I'll have to calculate the present value. Yes or no, everyone? Yes, sir. So, yes, I will be calculating, yes, the incremental NPV. I am bringing all my cash flows to, yes, present value, and how much extra NPV I am getting. If I go for new machine, I will calculate. Yes, if my incremental NPV is positive, replace, go for new machine. It is negative, don't replace, continue with the existing machine. Look at this, students. Yes, whatever is there in existing, I will ignore. Now imagine in existing machine, now every day 100 glass juice I am selling. In new machine, every day 150 glass juice I am selling. 100 glass right now also I am selling. If I go for new machine, how much extra I am selling? 50 glass extra. That only I will be considering. Is this clear, everyone? So the simple rule is, yes, in a replacement decision, when question asks you, should I replace it or not? Always consider only incremental cash flows. Okay, simple discussion we put is existing old asset is there, which is still in working condition, but a new better machine is there. So what should I do? Should I continue or replace? So how do I do? Yes, if I go for new machine, what is the benefit? As against that, for the new machine, what is the additional cost? Okay, but these are in different time frames, so I will bring them to present value. That is, I will calculate incremental NPV. If I go for new machine, how much extra NPV I will get? If I get extra NPV, yes, I will replace. Otherwise, I will not. So to calculate this, what all is needed? Look at this, students. Yes, in order to calculate NPV, what all was needed? Initial investment, cash inflow during life of the asset, terminal value. Now I want incremental in PV, extra. So I will see how much incremental initial investment I want, how much extra investment I want, how much extra cash inflow I'm getting, incremental cash inflow and incremental terminal value. Yes or no, everyone? Simple. So look at this. We will try explaining each and every step. Okay. Yes. Wherever possible, I'll try linking it to the example. Otherwise, just with the help of steps, I will tell. This, I think we can use it using this one only. Look at this. Should I replace the existing asset with a new asset or not? Okay. Incremental cash flow only I will be considering. Step 1, incremental initial investment I have to calculate. How much extra initial investment? Now imagine I am having existing machine. I told I don't want this existing machine. New machine I am purchasing. In order to purchase new machine, I have to pay cost. Yes or no? So total cash outflow to purchase new asset. What all I'll be paying? Purchase cost I'll be paying plus installation I'll be paying. Imagine 1 lakh purchase plus 10,000 installation. I'm telling 1 lakh 10,000 I paid. This extra cash outflow I've incurred because I've purchased new machine. But understand students, if I purchase a new machine, I will sell my existing machine, yes or no? From that I will get some cash. Existing machine was there, yes. To purchase new asset I paid 1 lakh 10,000. Existing machine was there. I sold and imagine I got some 30,000 back. Means net how much extra I paid? 80,000 only. So from that I will reduce the total cash inflow by selling existing machine. What is my total cash inflow? Yes, how much I will get by selling existing machine? Sale value I will get, but in that capital gain has to be adjusted. Yes or no, everyone? Terminal value, yes. Concept 0 NPV we have discussed. So from my sale value plus or minus capital gain I will get cash in. That will give me my incremental initial investment. Is this clear? Step number 1. Step number 2. Yes, incremental cash inflow during the life of new asset. Okay. How much extra investment I have to do for new asset? I calculated. How much to purchase new asset I am paying minus how much I am getting from existing asset. Okay, boss. Now, during the life, why did I purchase new asset? Existing asset was there now. Because from that some more benefit I am having. How much extra benefit I am getting? So look at this. How do I calculate that? Simple. Yes, from new asset, how much extra sale I will get? That is a benefit. Yes, if I can save some cost, that is also a benefit, saving in cost. But if I have to pay some extra cost, that is a loss. I have reduced additional cost. I have reduced. Yes, new machine, extra depreciation I am paying, that I will reduce. I will get the additional benefit from the new asset. Yes or no? Yes, sir. Additional benefit I got. Now on this tax also I'll have to pay. So on this I will pay minus my tax. I will get my additional profit after tax. Now the additional depreciation was a non-cash item. I will add it back again. I will get my additional cash flow after tax. Okay, everyone. If you want, you guys can see using this example. Look at this. Existing asset. Now I was getting a sale of 1 lakh. New asset 1 lakh 80,000 I will be getting. That means 80,000 more sale I will get benefit. Right now cost was 40,000. In future it will become just 25,000. That means 15,000 cost also I saved. That is also a benefit. But right now my depreciation was 10,000. In future it will become 24,000. 14,000 depreciation increased. That is a disadvantage for me. Loss. My profit will reduce minus 14. I'll tell overall my profit before tax will increase by 81,000. But on this 30% tax I paid. So I got my profit after tax. Additional depreciation is a non-cash item. I added this. So I got my incremental cash in. Is this clear? Okay, sir. Then I want step 3. That is incremental terminal value I'll have to calculate. Okay. Now understand simple. Okay. Yes. Incremental I have to calculate. Simple. I'm telling if existing asset was sold, ultimately how much cash I will get. If new asset is sold, ultimately how much cash I will get. That gives me incremental terminal value. I'm telling that boss, if existing asset was sold, na, I would have got, imagine 100 rupees. Okay. If new asset, because I have purchased new asset, because I am selling new asset, now ultimately I am getting, imagine 500 rupees. It means how much extra cash inflow I am getting at the end of the project because of new asset. 400 rupees extra. Yes or no? Perfect. So what I want cash inflow from existing asset. If existing asset was there, total cash inflow if new asset is there at the end of the life. And what is cash inflow at the end of the life, students? Is nothing but sale value plus or minus capital gain. Yes or no? So I will tell, okay, boss. Imagine you purchased new asset. Okay, sir, we purchased new asset. At the end of its life, you sold. Yes, sir, we sold. How much ultimately cash you will get? Sale value plus or minus capital gain. Okay. Imagine you did not purchase. Which asset you will be using? Existing asset. At the end of its life, you sell. How much you will get? Sale value you will get. But again, capital gain you will have to pay. Difference you will be getting. So that gives me my incremental terminal value. Yes or no, everyone? Perfect. Now once you have got the incremental cash flows, yes, incremental initial investment I got, Yes, incremental cash inflow during the life I got, incremental terminal value I got. Calculation is very simple. Bring all to present value terms. You will get incremental NPV. How much extra NPV I am getting by going for new asset. If it is positive means going for new asset, yes, new machine is good. Yes, that means replace, purchase new asset. If it is negative means it is not sufficient. That means do not replace, continue with existing. Is this clear everyone? This is going to be the steps. Look at this everything. Yes, in a detailed way I have written. Step 1, incremental initial investment. For new asset, how much extra investment I have to pay. Yes, first I will tell for new asset total how much cash outflow I am paying. Yes, purchase plus installation cost. But by selling existing asset, I will be getting some money as well. Minus total cash inflow, which is sale value plus or minus capital. This I got. Then during the life, how much extra benefit I am getting. Extra sale plus saving in cost minus additional depreciation will give me additional profit before tax. On this pay tax, you will get additional profit after tax. Add the additional depreciation, you will be getting cash flow after tax. Then incremental terminal value. Yes, terminal value is nothing but sale value plus or minus capital gain. In existing asset, what is terminal value? In new asset, what is terminal value? Difference is going to be my incremental terminal value. Based on that, calculate incremental present value. If it is positive, that means replace. Is purchase new asset. If it is negative means don't replace. Use existing asset only. Is this clear everyone? Yes or no? Okay sir, this is clear. Reasonably we have got an understanding. Next is type 2 question. There is also a second type of question which can be asked. Now understand the situation. It is a calculation of equivalent annual NPV and equivalent annual cost. Understand students? Imagine I am deciding to purchase. Okay, yes, sugarcane business I am planning to start. Two machines are there. Both machine, all features are same. Which machine will I buy? Yes, machine where my cost is minimum. Okay. Imagine cash flows are at different period, so I cannot add and directly compare. So what I will do is I will bring all cash flows to present value. Machine whose present value of cash outflow is minimum, that I will purchase. Yes sir. So imagine two machines was there. Yes, machine number 1, yes, present value of all cash outflow is 1 lakh. Machine number B, present value of all cash outflow is 1,20,000. Where cash present value of cash outflow is minimum? Machine A. So what I'll tell, go for machine A. But wait. Yes, machine A if I purchase na, I can use it for 2 years only. Machine B 1,20,000 I am incurring, but I can use it for 3 years. Which machine should I purchase? Now understand. Whenever there are 2 or more machines, yes, where life is different, I cannot directly be taking a decision. Yes, I'll have to calculate equivalent annual cost. Now what will I tell? I will tell boss that 1 lakh is the total cost I'm incurring on present value terms. This is for 2 years. I want to know for every year how much it is. Now how do I calculate my equivalent annual cost? Yes, it is a present value of cash outflow divided by present value annuity factor. In simple terms, I'll tell students, okay, too much logic is there. I'm not getting into any of those things. 2 years I'm paying. Yes or no? Year 1, year 2 I'm paying. Yes, I brought it to present value terms. I'm telling on present value terms it is 1 lakh. I want to know for every year how much it is going to be. Okay, yes, normally I will tell it is 1 lakh. You want to do it for 2 years, that means divided by 2, but it is wrong. Why? 1 lakh, yes, it is a present value of 2 years. That means while you're dividing, you have to divide by present value annuity factor of 2 years. Is this clear everyone? So I will divide by present value annuity factor. I will tell 1 lakh, yes, for 2 years present value annuity factor is 1.7355, assuming 10%. That means it is 57,620. 1,20,000. It is for 3 years. So 3 years present value annuity factor is 2.4868. That means every year it is going to be 48,254. Okay. Yes. In a bit more detailed way, if you want the logic, look at this everyone. Imagine, okay, there is a project for which every year for 2 years I have to pay 50,000. First year I will pay 50,000. Second year also I will pay 50,000. Can I calculate present value of my cash outflow? Yes, sir. Divided by 1.1 divided by 1.1 whole square. I got my present value is 86,750. Yes or no? 50,000 into 0.909 plus 50,000 into 0.826. Can I also write it as 50,000 into 0.909 plus 0.826. Yes, and what is this 0.909 plus 0.826? It is present value annuity factor. Yes or no? So I can tell that my present value is nothing but 50,000 into present value annuity factor of 10% for 2 years. Okay, 50,000 into 1.735. Will I still be getting 86,750? Yes. So I will write, look at this students, that my present value, okay, yes, present value of cash outflow, it is nothing but my annual cost. Every year how much is the cost into present value annuity factor. I want to know the annual cost. I will tell it is present value of cash outflow. This one, take it to the other side, divided by present value annuity. Is this clear? Is this clear? Is this clear, everyone? So I am telling, yes, what does it mean? What does it mean? It means that, yes, imagine at t is equal to 0, 86,000. Someone told me that, okay, today I will give you 86,750 da. Every year you will have to give me an equal amount. How much that amount is going to be? That equal amount is going to be 50,000. That is what I have calculated. Keep logic aside. If you have understood, great. Otherwise, simple formula, equivalent annual cost. It is a present value of all cash outflow divided by, yes, present value annuity factor. Simple. So here in this example, I am telling that if I go for machine A, every year my cost will be 57,000. If I go for machine B, every year my cost will be 48,000. Yes, I am purchasing machine. I want my cash outflow to be minimum, where my cash outflow is less. Machine B. So I will tell, okay boss, I will go for it. Is this clear, everyone? Simple summary is written here. Look at this. Okay. Yes, whenever I will be selecting between two different assets which is having different life, on what basis I will select? Either on basis of equivalent annual NPV or based on equivalent annual cost. Okay, equivalent annual cost is nothing but present value of all cash outflow, that is total I want for 1 year, divided by present value annuity. I want equivalent annual NPV, every year how much NPV I am earning. Yes, we have total NPV, that is for all the years, divided by present value annuity factor. Okay, so which asset I should be buying? Now, yes, if information about revenue and cost is given, this will not be there for us. For us exam perspective, only this is there. Cost information is given. Yes, two assets are there, different cost I am incurring. First, I will calculate present value of all cash outflow. Okay. Based on that, I will calculate equivalent annual cost, which is nothing but present value of all cash outflow divided by present value. Now comes decision making. Whichever asset present value, equivalent annual cost is a minimum, that is the most preferred. Is this clear? Suppose here only cost information is given, revenue data is not given, so I'll assume revenue is same only, so I'll ignore. Imagine cost and revenue, both information is given. Imagine one asset, yes, it is much more faster, so more goods I can produce, more revenue I'll be getting. Which goods? Yes, which machine I'll have to go? Both the machines are there. For both the machine I will calculate NPV. Okay, step 1, calculate NPV for every asset. Now imagine I got NPV of 1 lakh as well as 1.2 lakh, but this is for 2 years, this is for 3 years. Is it comparable? Not comparable, sir. That means what I'll have to calculate? Equivalent annual NPV. Yes, step 2, calculate equivalent annual NPV. How? It is NPV divided by present value annuity factor. Now understand decision making. Again, logical thing. NPV is how much net cash I am getting. Tell me students, as a businessman, as a wise person, cash inflow, should it be more, should it be less? Should be more. So wherever my equivalent annual NPV is more, maximum, I will go for that. As simple as that. Is this clear, everyone? Yes or no? Yes or no? Yes or no? Give me a confirmation. This is also over. Yes, then comes the final thing, which is optimal replacement cycle. Okay. Yes, what is this, students? Understand. Imagine I decided, yes, that I'm going to stop all these things, teaching and all these things, so much headache. Imagine, yes, we start a business. Simple. I will start, yes, running rented cabs. Okay, simple, like Ola. Okay, for that we want vehicles. And imagine vehicles we have to keep frequently changing every 5 years. Yes or no? So here the question is optimum replacement cycle. Ideally, in how much years I should change my vehicle? Understand? Yes. It is a tool used to determine the best time to replace the asset. It is used when project is long term in nature. Yes, renting business. Yes, vehicle renting, Ola business. I will carry for next 50 years. But for full 50 years, I cannot use this car. Yes, ideally, it requires frequent replacement. Yes, on what basis I will calculate optimum replacement cycle? It is based on equivalent annual cost. Yes, every option I will see, in every option, yes, annual cost how much it is, I will see. Based on that I will do it. Simple example only we will see, students. With this it will be very much clear. Okay, this is again going to be very important from examination perspective. Imagine sales employees are there. For them I am giving them a bike. Okay, that bike can be used for maximum 3 years. That means in 3 years, in any case, I'll have to replace. Purchase price of bike is 55,000. Yes, if I sell at the end of first year, second year, third year, this is the sales value. Then running cost is given. Every year, road tax and petrol and other cost also I am incurring. Okay, discount rate is 10%. Determine optimal replacement is period of the bike. Now understand what all options can be there. Option number 1, maximum how much year I can use the bike, 3 years. Option number 1, today I purchase bike. At the end of first year only I will sell. Is it possible? Sir, it is possible. Replace bike every year. Or I will tell, today I will purchase. First year I don't want to sell. At the end of second year I will sell. Possible. So possible. Or third situation, today I will buy. Maximum I will use. 3 years option is there. Okay, use full 3 years. At the end of it you will sell. Okay, so 3 situations are there. Either I will sell, replace bike every year, or every 2 year, or every 3 years. Now in each of these situations, I will calculate my equivalent annual cost. Simple. Pay attention. Yes. Scenario number 1, I am telling every year I am replacing bike. Understand what happens. Yes. At the year start, I will purchase bike. 1 year I will use. At the end of the year, I will sell bike. Okay. Data is given. Year start. Yes. In order to purchase bike, how much I have paid? 55,000 I have paid. I will calculate present value of all cash outflows. Okay, boss. I'm telling year start I paid 55,000. Okay, present value is 55,000. Okay, first year what happened? First year, sir, to run the bike, I have to incur some running cost. How much running cost I have to incur? Road tax 3,000 plus petrol 30,000. 33,000 I will be paying this. That is first year. I want everything at present value. I will bring it to t is equal to 0. Yes, into present value factor. Yes, I got this cost. Now, yes, first year, yes, at t is equal to 0 I purchased. 1 year I used, running cost I incurred. At the end of 1 year, I am telling I don't want this bike, boss. I don't want this bike. What will I do with this bike? I will sell this bike. Yes or no? When I sell the bike, I will get some cash for myself. Yes or no? So it is cash inflow. This is cash outflow. This is more cash outflow. This is cash inflow. I am reducing it. How much will be resale value if I sell the bike in 1 year? 35,000 I will get. Yes, this 35,000 I will get at first year. I want to know at 0th year. Yes, bring it to present value terms. Okay, so you get that present value of cash outflow is 53,182. Okay, boss. If I use bike for 1 year, na present value at t is equal to 0. Present value is 53,180. But I want the equivalent annual cost, every year's cost I want. Yes, present value of cash outflow, yes, divided by present value annuity factor. It is for 1 year. So I'm assuming 10%, 0.909. You will be getting it as 58,506. Is this clear, everyone? Now option number 2, I'm telling no, boss, every year changing. No, I don't like it. Every 2 years will change. Okay. At t is equal to 0, I will purchase. For purchasing, how much I have paid? 55,000. Now 2 years I'm using. That means 2 year running cost I'm incurring. First year running cost, second year running cost. Yes, I have to bring it to present value. I brought it to present value. I got the running cost present value. Next, at the end of 2 year, I'm telling no, I don't want this bike. I will sell. That means I will get some money. Yes or no? I will reduce my cost minus resale value. I got that at the end of second year. Bring it to present value. Second year's present value factor. Okay, you got total present value. That if I use the bike for 2 years, yes, what is going to be the present value of all cash outflow is going to be 99,039. You want to know every year, so you will divide by present value annuity factor for 2 years. You will get the equivalent annual cost is 57,080. Is this clear? Same thing will repeat for every situation. Now I am telling no, boss, I want to use for 3 years. You are telling okay. Yes, at t is equal to 0, you purchased bike, 55,000 you paid. Okay. Yes, first year, second year, third year. Every year running cost you are incurring. Bring it to present value terms. First year, second year, third year. Running cost you incurred. Bring it to present value. At the end of third year, I am telling I don't want bike. Sell it. Yes, you are recovering some amount minus resale value. Bring it to present value terms. Minus resale value. Bring it to present value terms. You got present value of all cash outflow. This is for 3 years. Divide by present value annuity factor for 3 years. You will be getting every year's equivalent annual cost. Is this clear, everyone? Okay. Now comes decision making. Pay attention, everyone. If I change the bike every year, my yearly cost is 58,000. If I change every 2 years, it is 57,000. If I change every 3 years, now it is 57,900. What I want? A cash outflow to be minimum. Where is it minimum? Every 2 years. That means what is my decision? Yes, replace the bike. Is this clear, everyone? Yes or no? So you are having the steps. Look at the students. Steps. Okay. Very simple. Yes, see what all situation can be there. Imagine our asset is having 5-year life. It means either every year I can replace, every 2 years, every 3 year, every 4 year, every 5 year. That much will not be there. Most of the times question will give you 2 years, 3 years or maximum 4 years. Okay. In every situation, calculate equivalent annual cost. That is, first see, okay, initial investment plus running cost present value minus scrap value or resale value present value. You will get present value of cash outflow divided by present value annuity factor. You will be getting equivalent annual cost. Once you get that in every option, see where it is minimum. That is going to be the best option. Okay. Now to get that, now we took so much time. There is a simple presentation as well. Yes, this is the alternative presentation. If we do this in a single table only, we will get the answer. Pay attention, students. Now first I will write particulars. It will help us save a lot of time. Which year? Present value factor. Then what all options? Replace every year, every 2 years, every 3 years. One by one we will just see. Yes, first I will calculate present value of all cash outflow. What all? Yes, cash I am incurring. First initial investment I am paying. Okay. Running cost I am paying. Okay. Resale value I am getting. I write initial investment is happening at t is equal to 0. There the present value factor is 1. If I replace every year, I will just explain first and third situation. Pay attention. If I replace every year at the start of at t is equal to 0, I am paying 55,000. Okay. Now first year running cost I have to incur. So I will tell first year running cost I am incurring 33,000. Present value I will calculate. Okay. Second year am I incurring? No boss. Third year am I incurring? No boss, because first year only I sold. Now at the end of first year I sold. So scrap value also I will get. So at the end of first year scrap value I got. I reduce it. So will I be getting my present value of all cash outflow? Yes, sir. It is for 1 year. That means divided by present value annuity factor for 1 year, you will get equivalent annual. Imagine 2 years. At the end of 2 years you are selling. You will purchase here at the end of 2 years. That means purchase you have incurred. Year 1 as well as year 2 running cost. Year 1 and year 2 running cost. Calculate present value. At the end of year 2 you sold, scrap value. At the end of year 2 you sold, scrap value. Present value of all cash outflow you got divided by present value annuity factor, you will get equivalent annual cost. At the end of 3 years you are selling. That means, tell me, at t is equal to 0, purchase cost you paid. Running cost, first year also, second year also, third year also. First year, second year, third year. The advantage here is, once you do for the last year, next previous years, this running cost calculation becomes very quick and simple. Because directly you can just keep on reducing this and figure there is no need to calculate at all. Figures will be available. So quickly you can finish it off. Okay, and at the end of third year you are selling. So scrap value from third year, bring it down to 0. Yes, present value of cash outflow divided by present value annuity factor equivalent annual. Based on that, you will be taking a decision. Is this clear, everyone? Yes or no? Optimal replacement cycle based on equivalent annual cost you are going to do. How? Step 1, yes, for every situation calculate equivalent annual cost. Wherever it is minimal, yes, that is going to be most preferred option. This is the presentation. Is this clear, everyone? Yes, then comes concept 3, miscellaneous areas. In this actually nothing is there. Yes, one small point, inflation adjustment could be asked. 1 or 2 examples are there. We don't know. Okay, now simple story, students. Imagine I decide that we are going to stop teaching. So much tension is there. Look at this. I'm not feeling well. Still, I have to take the class. Voice is not coming. Okay. So decide I will stop teaching. We will start a simple business. Which business? Lungi business. No need to explain logic only why to wear lungi. Everyone knows. Yes or no? If you want, come purchase and go. Okay. So I am taking a decision. Should I start a business or not? So I did evaluation at t is equal to 0. Okay, here I am starting and doing evaluation. How much cost I'll have to pay? Yes, year 1 how much I will get, year 2 how much I'll get, year 3 how much I'll get, terminal value how much I'll get, all those calculations I did. Yes, my simple calculation was that every lungi I will sell at 200 rupees. Variable cost is 100. That means for every lungi how much cash I will get? 100 rupees. Imagine I am telling that at year 1 I will be selling 1000 lungi. That means how much cash I will get? 1000 lungi into 100 rupee per lungi. That means 1 lakh I will get. Yes or no? Yes, I did my NPV calculation. This 1 lakh I brought it to present value. Yes or no? Perfect. No issues. Yes, life is simple. But wait. Understand. When did I take a decision? Here. That means this is selling price. When did I estimate? This selling price is today's selling price. Yes or no? Today when I am doing calculation, I told, okay boss, yes, first year I will sell 1000 lungi, every lungi I will sell at 200 rupees. But tell me one thing, at the end of first year, whether selling price of lungi will be 200 only or will it change? It will change, sir. What will come into picture? Inflation will come into picture. So what this concept is telling is, okay boss, you calculate your NPV, you take your decision. But while you are calculating, yes, every cash flow, if inflation is going to impact it, you have to consider the impact of inflation. Is this clear? Yes, this 100 rupee per lungi into 1000 lungi, 1 lakh rupees I will be getting this. Yes, I have not adjusted inflation in this. I'll have to adjust inflation in this. Is this clear, everyone? Okay. So cash flows can be two different cash flows. Look at this simple thing. Yes, general rule, always consider nominal cash flow and nominal discount rate. Cash flow can be two different cash flow. Yes, real cash flow, nominal cash flow. Real cash flow means I have not considered inflation. Nominal means I have included that inflation. Which one I want, students? In reality, what is happening? In reality, from the project, yes, year one cash flow, will I be getting based on today's selling price? No boss, year one selling price. Means inflation is there, I have to adjust inflation. Okay, simple rule, just to remember this thing. Yes, cash flow as well as discount rate, I want nominal. That is, inflation should be adjusted. Simple. Okay, so comes the question, two calculations are needed. Firstly, how do I calculate nominal cash flow if question has given real cash flow? Second, how do I calculate nominal discount rate if question has given me real discount rate? Okay, simple. Okay. If inflation rate is same, look at this simple calculation. This one only I will do. Yes, I did the calculation today that year one, yes, 1000 lungi I will be selling. Every lungi at the rate of 100 rupees I will be selling. Okay, this calculation I did here. Imagine first year's inflation is 10%. So here I did a calculation that 1 lakh I will be getting. But actual cash I am getting first year end. It means 1 year's inflation I'll have to consider, I'll have to include. Yes or no, everyone? Yes, I will be doing into 1.10. I'm telling boss, I estimated that every lungi I'll get 100 rupees, but inflation 10% is also there now. That means I'll be getting 110 into 1000 lungi. That is 1,10,000. Or in simple terms, I'll tell, yes, real basis, I estimated that real cash flow of 1 lakh I'll be getting. But inflation is also there into 1.10% inflation. Is this clear, everyone? Simple. Yes, you're having real cash flow. Yes, that you've estimated today. I actually cash flow I'll be getting in future. That means interest, or here it is inflation. I will include. That means into 1 plus inflation. If inflation rate is same, yes, you will do into 1 plus inflation to the power of n. Inflation rate is different. Every year separately you will add. Now look at this. Imagine I estimated 10 lakh. First year inflation is 10%, second year is 12%, third year is 15%. At third year, how much I will get? Simple. 10 lakh is there into 1.10. Here I reached into 1.12. Second year I reached into 1.15. Third year I reached. Is this clear? That is why I have discussed that concept of present and future value to play here. Is this clear, everyone? So look at this. Simple. Yes, I want to calculate nominal cash flow. How do I calculate? Yes, real cash flow is given. Yes, inflation adjustment has to be done. It has to be, yes, included. That means into 1 plus inflation rate. If inflation rate is same, it is real cash flow into 1 plus inflation to the power of n if multiple years are there. Different rates means real cash flow into, yes, every rate individually you will keep on increasing. Okay. Now comes one more point, which is nominal discount rate. This is again going to be important, students. Yes. Formula is simple. Nominal discount rate is 1 plus real discount rate into 1 plus inflation minus 1. Or in simple terms, you can tell 1 plus factor into 1 plus factor minus 1. Okay, logic. Just in 2 to 3 minutes, I will tell, pay attention. Not going in detail everywhere. This is the formula. 1 plus real rate into 1 plus inflation minus 1. Okay, it is 1 plus factor into 1 plus factor minus 1. You can just keep it that way in your mind. Now, how do I explain it? Simple. Imagine today I invested 1 rupee. Okay. First year, yes, I want 10%. Second year, I will be getting 12% interest. Total, how much I will be getting? I will tell 1 rupee I invested, boss. First year 10% means 0.1 I will get. It will become 1.1. Second year 12% on this. That means 1.1 into 12%, 0.132. That means total how much I will get? 1.232. Yes or no? Okay. That means this is the total amount I will get. I want to know how much interest, how much income I will get. Well, simple, boss. Total I got 1.232. I invested 1. That means I got 0.232. Yes or no, everyone? Perfect. Yes, in percentage terms, if you want to tell means, okay, 0.232 you got on 1 rupee, that is 23.2%. Now understand, can I get the same answer using a simple shortcut? I will tell, if I put 1 rupee means first year how much I got, 10%, 1.10. Second year how much I got, 1.12. This gives me total income. Yes, total amount. I want income only minus my principal amount. Yes or no, yes or no, yes or no. Yes, 1 plus factor into 1 plus factor minus 1. 1 plus factor into 1 plus factor minus 1. That also gives me 1.1 into 1.12 minus 1. 0.232. That is 23.2 percentage. Same thing I'm telling. Okay, boss, I've invested in the business. Yes, what all? Yes, the amount I've invested, what all it should give me? Yes, 1 plus a real discount rate. Yes, real income, what I'm expecting to earn, that anyways it should give. In addition to that, inflation's amount also I should be earning. That also it should be covering. That gives me total return minus 1. Gives me my nominal discount. Is this clear, everyone? If you want one more final example, simple I'm telling. Imagine, yes, I'm having a dream that next year I should buy a car. Okay, what is the selling price? Sir, yes, car price is 11 lakh rupees. So what I did today itself, now, yes, I did one thing. I went to bank. I created an FD of 10 lakh rupees. Why? And the estimation that FD will give me 10%, assume. So I'm telling, okay, today I put 10 lakh rupees in FD. At the end of 1 year, it will give me 10%. It will become 11 lakh. Yes, 11 lakh I will withdraw. I will go, I will buy car. Dream fulfilled. This is my mission in life. But tell me, students, 11 lakh is a selling price of car. When? Today. At the end of first year, whether selling price will be 11 lakh only? No, it will not be 11 lakh. Inflation will come into picture, yes or no? Imagine 5% inflation will be there. That means what will be the selling price after first year? 11 lakh plus 5%. Imagine 11 lakh plus 5%. 11 lakh plus 5%. It will become how much? It will become 11.55 lakhs. Yes or no, everyone? Perfect. That means actually how much return I should be getting. If I put a 10 lakh, okay, if I put 10 lakh, yes, 10% return anyways I want. In addition to that, 5% inflation also I should be getting. That means total how much I want. Yes, on 10 lakh, I want 11.55 lakh. Yes, 1 lakh 55,000 I want on 10 lakh. That is 15.5%. Actually, totally I want. Real income also I want. Inflation also I want. So totally I want 15.5%. How do I get that? Simple, boss. I can tell, yes, if I put 1 rupee means, yes, 0.10 real income I want. In addition to that, how much is inflation? 5%. 1.05. That gives me total amount minus my principal of 1. If you do that, 1.1 into 1.05 minus 1, you'll be getting 0.155, which is nothing but 15.5. Is this clear, everyone? Yes. What is it? Go by the gist of it. Go by the feeling of it. What is it telling? It is telling that, boss, in reality, ultimately what I want to earn, whatever I thought, in my mind, I'm telling 10% return I want. That I want. Apart from that, for inflation also I have to cover. So 1 plus real discount rate into 1 plus inflation minus 1 gives me my nominal discount. Is this clear? Yes. A very important note here. If you are having depreciation, question tells every factor, yes, inflation is there by 10%. Every other item, sale, cost, everything will change by 10%. Depreciation is not impacted because depreciation is my past cost. Is this clear, everyone? Okay. Yes, that is one point. Now, except that, what more is there? Look at this. Impact of inflation is over. Yes, there is a small point called as simulation. Exam perspective, not at all important. There is no question also. Yes, nothing is there in that. Only some 3-4 lines I say is given. I am not discussing here. Adjusted present value. There is a topic like this. Yes, my explanation. Yes, it has some link to business valuation. At that particular point, I will be explaining. So even though it is there in study material, I am not telling. Real options. Options again will come with derivatives. So I am not telling. Yes, I'll have to go to, yes, what is options, all those things I'll have to be telling. So I'm not explaining this here. So from your study material, if you want in this chapter, these are 2 points extra you can do. Okay. Next, one more small point is there, which is utilities. One simple jujube question is there. Okay. What question has done is, yes, what is my expected utility? It is a summation of utilities into probability. And wherever yes, utility is highest, that you will yes, implement. Simple question is telling that, okay, cash flow question has told. For every cash flow, utility question has told. Okay, and against that, probability question has told. What I'll have to do? Question is asking what is the expected utility. Yes, the utility into probability. It's a summation I will do. Simple. That gives me expected utility. Imagine project 1 expected utility is 3 and project 2 expected utility is 5. I'm telling wherever my expected utility is maximum, that I will do. Yes, you see there is one question in the study material. If you see the question, you will smile. Telling, okay, ICA will not ask this much jujube question. This is like a cheap question. Okay, I normally don't use that term, but it is that only. Okay, everyone. So this, with this we have finished the chapter Advanced Capital Budgeting. Now, if you guys want from here, I can give you a rocket revision in 20 minutes. But okay, we've spent I think around some 2 hours or something. But yes, to a reasonable extent, we've explained. Okay, again, I'm telling one thing. Okay, I am not convinced with this level of explanation. Okay, because if I explain, my objective is if I'm doing one plus, I'll have to tell exactly why I'm doing that plus. Okay, but with the time available, it is not possible. Okay, yes, we were supposed to take it some 10 days back, but due to health condition we could not take it, so extremely sorry for that. Yes, all these files will be shared in our Telegram groups. Yes, I hope you guys will use that. Tomorrow forex rocket revision we will do. Yes, if you guys want this advanced capital budgeting also rocket revision in 25 minutes, I can do it and separately upload a video for you guys if you. Okay, so all the very best for your examination. Yes, go with the present mind, do not think so much. Yes, read the question properly. Based on that, based on whatever you know, do it. Okay, in this chapter, three most important topics from where yes, high probability of a question coming in examination. First is sensitivity analysis. Yes, read the steps. For everything I've written the steps. Yes, I was not in a position to explain in detail due to time constraint. Next is statistical techniques. In that, perfectly independent cash flow. Yes, after that comes my replacement decision. The most important thing, students. Yes, definitely you will find a 7 to 10 mark question. Okay, so please do this. Okay. Our voice is also gone. Okay, so with this, can we end the session, students? Don't worry, the video will be there on YouTube. So at any point, if you want to refer to any of those things again, you can just do it. File will be shared on our Telegram group, Think with Tabish. Okay, that's all for this session. I hope it was worth it. So shall we consider ending the session, my dear students? Okay, thank you so much. Okay, so all the very best, my dear students. See you for the next session. Until then, keep studying, keep smiling, keep working hard, keep making your parents proud, and make this your last attempt. Okay, yes, in 2 months, your registration number should change from SRO to MRO. Yes, that should be your objective. Okay, dear. Important question list from study material I have not covered as such. Okay, I've told you, right, these three topics. Try looking at the question. You will get a gist. Every adjustment also I've explained, but you'll have to just see the question. Okay, dear. Thank you so much, sir. It was a wonderful session. Really worth it. Thank you so much, dear.